ವರ್ಕಿಂಗ್ ಬರ್ತದೆ. ದಿಸ್ ಐಲ್ ಚೇಂಜ್ ಇಟ್ ದಿಸ್. Done. Yes. Link. Yeah, I'll open. It's there. Part 1. Yeah. Yes, guys, we did have some hiccups. It's always good to have some hiccups in the beginning so that later you don't have any problem. Maybe someone didn't pray to Lord Ganesha before coming to class today. And someone has sent a message saying that no class today. You don't want class today, Guru Prasad. Can we get started? Whatever goes bad in the beginning and later becomes fine is always a very happy thing. Whatever goes very nice and cruising from the beginning, people won't really appreciate. See, they won 5 trophies. Where is the sports versus sports spirit? We saw, see, 7 matches, only 6 lost. Look at the kind of happiness at the end when you get qualified. So initially when you get successful, it won't be really nice. When you almost think you've lost it, from there if you come back, that is a very big story. And that's a story that is very inspirational, and that is a story which can make you smile very wide also. So sorry for all the small interruptions that you had in the beginning few minutes with regard to things which were not in our control. Are you all ready to get started? So Mission September 2024 for CA Foundation Accounting, there we come. So we're starting with CA Foundation Accounting for September examination. People, whoever are writing their examination in the month of, oh shit, what am I talking? Inter September. We'll start again from fresh. Okay, you also close your eyes and then open once again. Okay, fresh start. Open your eyes. A very good afternoon, everyone. Welcome to Yashas Academy. We are on a mission to clear our examination in June 2024 CA Foundation Accounting, and there we go. We're gonna do entire revision of entire syllabus of CA Foundation Accounting in today, tomorrow, and day after tomorrow's class. People who are writing your examination in the later date also can surely watch this. There's going to be no amendments in accounting. This is not tax and law. Come on. So here's our brief plan about how we are going to handle the topics. Today, day 1, 20th of May, we're going to do chapter 1, 2, 3, 4 and 5. This is usually 50% of the syllabus as per previous syllabus, but now it's not going to come to 50%. This will be hardly 30% or even in fact lesser than 30% in examination. And tomorrow's class, 21st of May, we'll be doing 6, 7, 8 and 9. That is bills of exchange, final accounts, NPO and income debt records. And 22nd of May, when RCB will be taking over RR, we'll be doing 10 and 11 partnership and company accounts. So the plan will be to finish ASAP that day, but I can't promise you anything, just like the result. So can we get started with chapter 1, theoretical framework? No beating around the bush, and I won't tell you any tips at the beginning. So we'll discuss the tips at the end as to topic wise. I'll go on telling you how to follow the tips. My only message or request to all of you people, when you start studying the subject of accounts, please put the weightage to dustbin and then start studying. There is no weightage. There is no prior percentage given. Yes, I agree that you all have access to one PDF in the ICA website which tells that 10 to 15% marks from this chapter, 5 to 6% marks from this chapter, 20 to 30 from this chapter together. Please don't follow. It won't work. You do this strategy analysis, you would be watching marathon revision once again, which I don't really want you people to be doing it. Yeah, humble request, if you want to give it a try, please take one of the past examination, take one of the past weightage analysis, compare how many marks has come, how has come. Even if by mistake some topic matches with the percentage of weightage, because of the choice question that you have, it will go outnumbered. You do 4 or 5 topics together, which comes to 70% of your weightage as per the PDF given by ICI. Then you start writing the examination question paper. You see whether will you be able to get 70 marks. You can't. And one more very important thing that I want you to notice, the chapter that you skip might have the easiest question in the exam. The chapter that you do as like this is my strength, what if the most difficult question comes from that very topic in the exam? So I always believe in skipping topics. You should skip chapters in the examination hall after you see the question paper. Not when you're studying, not when you're revising, especially not when you're preparing. You get it? So we will do all the topics in these 3 days. Can we start with introduction to accounting? Let's start with a brief history of the word accounts. So whenever we see the word accounts, the primary question that should shoot in our mind is, what exactly do we mean by the word accounts? So what is accounts? The name itself signifies it is counting. If you observe the name, it has COUNTS, counts in it. So the man started counting long ago. We're talking about the times when there was early men in the cave. He started keeping count of number of kids he had, number of cattle he had, number of wheels he made. From that day to the modern day, where we open to see how many followers have I got overnight. Yeah, how many views have I got on the reel that I posted, and how many messages have I got. So you check all of that. That is also keeping count of things. Or if you are a professional looking into Instagram for professionals like LinkedIn, so there you see something, that is also keeping a count of things. Or you check your mailbox, you see how many mails you have received, how many mails you sent. That is also a count of things. Or you might get that one message on your mobile phone every day, no? Morning, your bank balance is so and so. That is also a count. So, or if you keep money in your demat account or investment account, what you see there numbers, that is also a count. So accounts is a count of things. So it is keeping a count of things. But talking about the definition that one has to read for the examination goes like this. Accounts is a systematic record or track, where the definition is given by AICPA in 1941, American Institute of Certified Public Accountants. It says that accounts is an art of recording, classifying, summarizing in a significant manner, and in terms of money, transactions and events, which are in part or at least of financial character, which is usually analyzed, interpreted and communicated thereof. Sir, why are you going at this speed? This is a topic which will not come in the examination. Don't expect a question on what is accounts in the examination. That is over in second PUC accounting for 2 marks. So, but I cannot go forward without telling the definition. Every aspect in this definition, whatever you have, recording, classifying, summarizing, analyzing, interpreting, communicating, we have a detailed discussion on each of it in our first and second chapter. So you should know the overview of the definition, that is accounts. Going a slide forward discussion, we'll ask ourselves, what do we mean by transactions and events? So what do we mean by transactions and events? All the human activities that we basically do will be transactions and events, and then we'll record it in books of accounts. If they're not transactions and events, we are going to ignore them. The question is, when do we call an item as transaction? When do we call an item as event? Human activities, what we do, coming to class, going home, sleeping, eating, all of these are human activities. Certain human activities affect in money or money's worth. They are called as economic activities. Certain human activities don't affect in money or money's worth. They are called as non-economic activities. We ignore non-economic activities. We focus on economic activities among human activities. The human activities which are economic activities will be further checked. Are they relating to the business or are they not relating to business? If they don't relate to business, again you will ignore. If it is an economic activity and if it relates to business, that's when we call it a transaction. So for a human activity to become a transaction, it has to go through 2 conditions. Number 1, it should be an economic activity. Number 2, it should be relating to business. Do you get that? Very good. So further, the transactions can be classified into internal transaction, external transaction, cash transaction, credit transaction. It is important to spot this. If we don't spot a cash transaction, credit transaction, internal transaction, external transaction correctly, you might end up writing wrong journal entry. Then you would have to do rectification of errors, which if you do, you will get marks, which if someone else do, they'll cut marks. Talking about transaction. So in short, what did I tell you? It's an economic activity that relates to business. Now, what do we mean by economic activity? Which affects in money or money's worth. Which affects in money or, very good. If it affects in money or money's worth, we call it a transaction. Then let's identify certain transactions within this. Are you ready? I'll show up a transaction, or it might be not a transaction. I want you to tell me whether it is a transaction or not a transaction. To start with, we will start with started business with cash of 1 lakh rupees as capital. Is it a transaction or not a transaction? Capital relates to business, 1 lakh rupees. It's an economic activity. It's a transaction. How about filling a bank application and receiving passbook and debit card from the bank? Why not a transaction? It is relating to business, but it is not affecting you in money or money's worth. In the same bank, if you deposit money, in the same bank when you withdraw money, the same bank gives you interest. If the same bank charges you bank charges, transaction. You get it? Then next step. deposited 70,000 rupees into this bank. Transaction or a transaction? Very good. How about purchasing a plant by paying 20,000 rupees by check? What is it? Very good. It's a transaction. And then we have appointed workers for operating the plant. The plant and machinery, whatever you just installed, in order to operate it, you appointed some workers. Transaction or not a transaction? Not a transaction. If you pay them salary, very good. Then paid wages to these workers who are operating the plant. Transaction. How about receiving free sample from the supplier, the person who's supposed to supply to goods to us, no? From that person we received some free sample before we place the order. Pre-order sample received. Transaction or a transaction? If we give sample, it's an advertisement expense. There will write the entry, advertisement expense account debit to purchase account. However, if we receive sample, it is not a transaction. Then issued price list to customers. Customer came, you gave them the price list, details of the product and the price at which these products will be sold by us. Transaction, not a transaction? Not a transaction, a red flag. How about issued free samples to customers? We are giving free sample to our customer. Transaction or not? Yes, it is a transaction. You get that? Then last one. What if you sell goods to customers? Transaction or not a transaction? If you sell goods to customer, yes, it is a transaction. So we now understood how to classify a transaction, how to classify a human activity into transaction and not a transaction. If it is a transaction, we are going to pass an accounting entry for the same. However, if it is not a transaction, there would be no accounting entry for the same. Now, further classification of transactions into internal, external and cash and credit. This depends upon the categorization basis. If you look at it from the basis of people involved, you call it internal, external. If you look at it on the basis of money involvement, it will become cash and credit. Let's see the first one, settlement in cash. If the transaction gets settled in cash instantly, it is called as cash transaction. If the transaction doesn't result in immediate settlement, the settlement is deferred or postponed to a later date, then it will become credit transaction. Let me repeat, when do we call it a cash transaction? When the transaction is immediately cash settled. The transaction is complete. You purchase goods, you immediately pay cash, transaction is over. You sell goods, you receive cash, immediately the transaction is settled, over. That is cash transaction. Credit is where it is not cash settled. There is still some due in receivable or there is still some due in payable. So whether receivable or payable is not yet settled in cash, it is deferred to be settled on a later date, then it will become a credit transaction. Then see this, what is cash transaction? Settled by immediate receipt or payment. Credit transaction, settlement is not immediate. Then we will see some transactions wherein you need to identify whether it is cash or credit. Will you? Before that, what are the rules to decide? See, if the transaction says cash, then what is it? Cash transaction. If the transaction tells credit, then it is. If the transaction doesn't tell whether it is cash or credit, then what do? Then you check for name. If the name is given, credit transaction. If the name is not given, that's it. Because if someone asks you for loan, basic thing that you will do is you will at least ask their name, no? Some customer walks into your shop, he purchases goods, he gives cash, then you will say get lost. However, he purchases goods, he will say I will give money tomorrow. But have to at least write his name down, no, as to who is he. You will ask, what's your name? You will ask. So when the name is given, it is credit transaction. You get it? So please see this. So when do we call a transaction as cash transaction? When it is mentioned as cash. And the transaction itself, it's mentioned as cash, then it is cash transaction. If it is mentioned as credit, then it is credit transaction. If they don't mention whether it is cash or credit, then you will check whether the name is mentioned. If the name is mentioned, then it is credit transaction. If the name is not mentioned, then it is cash transaction. Clear? I hope you don't have any doubt. Now, sometimes they don't straight away give the word cash. They'll say it is received. Goods have been sold and amount is received. Goods have been sold and amount is settled. Payment is received. Payment is made. So they will use some synonyms, indirect words to say that it is settled. So be little wise enough to understand what are they trying to tell, though they don't use the word cash upfront. They might use the word paid, received, settled or several other synonyms in the place of word cash. Now there we go. We'll take some examples once again. The internal, external. It's small misorganization. Yeah. Classify the following into cash and credit. Are we ready? See the first one. Started business with cash of rupees 1 lakh as capital. Very good. Then deposited 70,000 into bank. Why not credit? What can you deposit in bank? Kidney? No, you would have to deposit cash only. So obviously what you deposited is cash. Then purchase plant by paying rupees 20,000 by check. Whether you pay by check, phone pay, Paytm, paid. It is cash transaction. It is settled. The other person has not cleared it. To you, you will affect your bank account. To you, will affect your bank account. Sir, what if the other party has not deposited the check, it is not cleared? That there we do reconciliation. We will write the entry when we issue the check, not when the other party deposits the check in the bank. Okay. After this, what if you pay the wagers some money? Cash. Then wages outstanding amounts to 2,000. 2,000 rupees there is wages, but it is outstanding. Credit transaction. Why? It's not paid. How about purchased goods on credit? The name itself, the transaction itself says credit. Then it is credit transaction. How about purchased goods from Kiba for rupees 3,000? Credit? Why? They have not mentioned cash. But they have not mentioned credit also. They mentioned the name. How about sold goods to Sakura? Rupees 7,000. They haven't mentioned name. Further they mentioned, they haven't mentioned cash. Further they mentioned name. So what is it? Credit. Very good. How about sold goods to Sasuke for rupees 7,000? Cash. Cash is mentioned. So it is very good. Then let's see internal, external. Are you ready to see what is internal and what is external transaction? See, if it is settled in cash, cash transaction. If it is not settled in cash, credit transaction. Now we'll check people involved. If the transaction involves another person, then it is external transaction. If the transaction doesn't involve another person, it is happening within the business, then it is internal transaction. When do we call it internal? Doesn't involve another person. When do we call it external? Involves another person. Yeah, shall we take some examples? Did you see all the answers? People who are watching it on YouTube, you can take some pain in typing the answer or sending the color. Green color is yes, red color is no. Green is internal, red is external. I've got good afternoon and after that I didn't get response. Cool. First one, started business with cash of rupees 1 lakh as capital. There is no other person involved. It is you and your business. Sir, Gandhiji is involved in the note is there. No, that doesn't count. People who are alive, people who are actively taking part in the business or who's getting some benefit or they're giving some benefit or taking some benefit from business. So this is internal transaction. How about depositing 70,000 into bank? External. Bank is an external person. There is another person involved. What you keep? I'm not talking about the piggy bank wherein you put the money. I'm talking about the bank. So this is an external transaction. Why? There is another person involved. Bank is an artificial person. How about purchasing plant by paying 20,000 rupees by check? You paid 20,000 rupees. What is it? External transaction. How about paying wages to workers 10,000? Internal, external? External. Why? He's an external person. No, one more person is involved there. He is working within the entity, but he and you both are same. No, he's a separate individual. You will in fact open an account by his name. So what is it? It is external transaction. How about purchasing goods for rupees 2,500? They have not given any person's name. Whom did you buy from? You bought it from a person, no? Am I right? Whether artificial person or a real person, you bought it from another person. So this is an external transaction. How about goods which are not insured or are getting destroyed by fire? Internal transaction. There is no other person involved in it. You get this? Then sir, what if God of fire? God of fire is not counted as a person for accounting. You get it? What if the same goods were insured? Why? Insurance company is involved. Our loss will become their loss. So they will have to compensate money for us. So this will become an external transaction. How about depreciation that is supposed to be charged on plant? Sir, plant is a person. Plant is not a person. We're talking about plant and machinery. It's not Groot who's a person. So plant pay, if you compute depreciation, this will become internal transaction. So now I hope you understood the transaction part as well. Yes, very good. So idella aitu. Now what is accounts is over. Father of accounts is Luca di Pacioli. However, there is an earlier prescription given by Chanakya in his book Arthashastra. Not relevant, so we'll rush it forward. Now we'll discuss the approach for accounts. Approach for accounts which is globally accepted is two. UK approach, US approach. UK approach is called as English approach or traditional approach. US approach is called as modern approach or American approach. So both the approaches tell the same thing. We have another approach also which also tells the same thing. Which one to follow? You can follow whichever you want. Ultimately the answer will be same. I will not correct you and then tell you have to follow only this. I have learned only this. You have freedom. You are in a country which has given you freedom to even abuse the Prime Minister of the country. So there is nothing wrong in choosing the method one among three. You get it? So you can follow whichever method you want. Okay. To begin with, the first one, like I told you, UK approach, traditional approach or English approach. There is another one called as US approach, American approach or what you call as modern approach. And there is one ultra modern approach which is going to become famous in the future. You guys are the first generation of people to learn it. So this is called as Bangalore approach. So this is another approach which is very similar, says the same thing what other approaches tell, but in a more simplified manner and a fun way. And I made this up. Okay, this is actually not there. Don't write in the exam Bangalore approach. I cooked this up in my kitchen. So Bangalore approach, yellow color kanasta illala. Yeah, sure, they've gone home. It's okay. Red is bright. Yeah. So Bangalore approach. Under the Bangalore approach, what it is, you need to remember the word Bangalore. What is it? B-A-N-G, bang. If you hit really hard. And after that, when you open the rest of the fingers, that will take the remaining letters in the spelling of Bangalore. B-A-N-G. A-L-O-R-E. So that is assets, liabilities, owner's equity, revenue and expense. The easier and shortcut to remember the entire accounting approach will be very simple. If in case you take assets and expenses, if they are increasing, we have to debit it. If it is decreasing, we have to credit it. So asset and expense, increase debit, asset and expense, decrease credit. The remaining three fingers, liability, owner's equity and revenue. Liability, owner's equity and revenue. If these three are increasing, we call it credit. If it is decreasing, we call it debit. Let me repeat. Asset, liability, bank, asset, liability, owner's equity, revenue, expense. A-L-O-R-E. Asset and expense. A and E. Debit increase, credit decrease. Liability, owner's equity and revenue. Credit increase, debit decrease. And that's the basics. And the same thing is told in different way. UK approach categorizes the accounts into how many categories? Two categories, personal accounts and impersonal accounts. And they give three golden rules. Golden rules are three, types of accounts are two. How many golden rules do we have? Three. Golden rule for accounting for real account. It says debit what comes in, credit what goes out. Then the rule for nominal account says debit all expenses and losses, credit all incomes and gains. And the rule for personal account says that debit the receiver of benefit, credit the giver of benefit. So this is a very simple golden rules given by UK approach. And like I mentioned, types of accounts are how many? Two. Personal and impersonal. Personal accounts are further classified into real personal, artificial personal and representative personal account. Sir, what about real account and nominal account? They both are impersonal accounts. Let me make you quickly understand what are all of this. Real personal account. Real personal account is account of real persons. Me, I am a real person. You are a real person. I am not alien. You are not alien. AB de Villiers is alien. AB de Villiers is not a real person account. So, real person. If there are real person with skin, blood, bone inside, they are real personal accounts. Am I right? Then what is artificial personal account? Artificial personal accounts are persons who are created by law. Not persons created by God. Persons created by law. We have created it based on our law and statute. Partnership firm. Partnership firm. Does partnership firm have birth and death as per the God script? Then Yamaraj will come and take the partnership when it is dissolved. No, it's a person that we have created by ourselves. By the act that we have passed called Partnership Act. Company, artificial person, association of person, body of individuals, or any other cooperative society, bank, all of these are artificial persons what we have created. What is representative personal account? These are actually accounts which represent a real person or an artificial person. When you say something called prepaid expense or when you say outstanding salary, salary advance, outstanding interest. So these all representing, when you say outstanding rent, it represents landlord who's a real person. If you say outstanding salary, it is representing an employee who's a real person to whom you owe money. If you say outstanding interest, it represents the loan that you took from a company or loan that you took from a financier, real or artificial person. That is representative personal account. Representative personal account represents a real or an artificial person. Then we have real account and nominal account. Real account is account of assets. Nominal account is account of all expenses and incomes. Clear? I hope this space is okay with you all. If you have to finish 1, 2, 3, 4, 5 today without skipping topics, this is the speed at which I should go. Everyone's fine with it? Very good. It is called marathon for a reason. And asset definition, nominal account definition, and I've given you real, personal and artificial accounts definition. I just explained these things to you. It's however there here. You can all go back and then watch it again on YouTube if you want. If you want detailed learning, go to this particular video, pause it, take a screenshot and then read. If not, I think I am fine to go forward without spending more time on this basic. Can I? Very good. Then we will discuss the US or American approach. Under the US or American corn approach, under American sweet corn approach, there are 5 accounts. How many things? 5 things. Sweet and salt peka, tangy lemon, mint masala, butter and salt. Classic. So in US, there is nothing called mint masala, mix masala, peri peri. Indians, we made it. Butter and salt is the classic. We're having butter and salt in break today. So 5 categories: asset, expense, capital, liability and income. Asset and expense, if it increases we should debit it, if it is decreasing we should credit it. Capital, liability and income, if it is increasing we should credit it, if it is decreasing we should debit it. That's it. Sir, isn't this same as our Bangalore approach? I think they've copied. No, we are copied. We are a copy. We have copied it. Theirs is true and original. It's okay. Copy also has its own value. Let's understand the definition of the word asset, liability, expense, income, revenue, capital. Shall we? To begin with asset. What do you mean by an asset? Asset is a resource controlled by the entity. It's a resource. We won't call item. We won't call asset is something, asset is anything, asset is this thing, asset is that thing. No. Asset is a resource. Resource can be used again and again. Source means once. Resource means replay. You can use it multiple times. It's a resource. And to call it ours, we should have a control over it. Is ownership mandatory? Ownership, if you have it, good. But ownership is not mandatory. What is more important? You should have control. So resource controlled by the entity. This is arising because of a past event and this is giving future economic benefit. This is arising because of a past event and this is giving future economic benefit. That's when we call it an asset. You get it? So this is the meaning of asset. Asset is a resource controlled by the entity arising from past event giving future economic benefit. So then types of assets. Assets based on the period of holding can be classified into period of holding. We can call it into current and non-current. Based on the tangibility, touch, feel and sense, we can call it tangible and intangible. So to begin with, based on the period of holding, we'll classify them into non-current assets and current assets. Now when we say fixed assets or non-current assets, how do we decide a specific asset is non-current asset or current asset? It is based on the period of holding. What period of holding is a decisive factor? We're usually under the conception that 12 months. If it is less than 12 months, current. If it is more than 12 months, non-current. That is not necessarily the point. We'd have to check operating cycle in mind. We have to keep operating cycle in mind. So what do you mean by operating cycle? From the time you buy the raw material to the time you sell the finished goods and collect money from your customer, how much ever time is there, that is called operating cycle. From the time you buy the raw material, convert it into finished goods, sell it to the customer and collect the money from the customer. The time gap is there, no? That is operating cycle. Any asset whose benefit will get exhausted within the operating cycle is current. If the benefit from an item will last for a period longer than one operating cycle, becomes non-current. I repeat, any asset or any liability which will get expired within the operating cycle is current. If its benefit is prolonged for a period longer than one accounting period, it becomes non-current. However, if the operating cycle is lesser than 12 months, then we'll take 12 months as the basis. If operating cycle is more than 12 months, then we can take 12 months as the basis. So it is comparison between operating cycle and 12 months. It's not 12 months in isolation. It is not operating cycle in isolation. Do you get this? Very good. It's a classic point where usually people get it wrong. So I wanted to break that chain of misconception and then make it clear to you people. Further, our fixed or non-current assets, whatever are there, are classified into two classifications: tangible and intangible. Tangible, which has touch, sense, you can see it and you can feel it, that is tangible. What is intangible? Which cannot be touched, which cannot be seen, but can only be felt. Yeah, example, El Clasico example. Always you'll say only one thing: goodwill. But there are a lot of other intangible assets: know-how, patent, trademark, copyright, license, and goodwill also, of course, whatever you tell. Then current assets, we won't classify them into tangible, intangible. You just imagine going to your debtor and then saying, can I touch you? Why? I don't know if I should call you tangible debtors or intangible debtors. If you try to touch, they'll touch. They'll touch really hard. So please don't try to check whether a current asset is tangible or intangible. Tangible, intangible classification is only for non-current assets, that is fixed assets. Further discussion is on liability. Liability is exactly opposite to asset. What do you mean by asset? Asset is a resource, liability is an obligation. Asset is a resource, liability is an obligation. I told you again with regard to asset that it is a resource arising because of a past event, because of which you will get benefit in the future. What is the definition of asset? Resource controlled by the entity arising from past, because of which there will be future economic benefit. Liability is an obligation, which has arisen in the past, because of which in the future we are going to have a outflow of resources. So it's a present obligation of an entity arising because of a past event, and this will lead to outflow of resources. This will result in what? Outflow of resources. So what is the meaning of the word liability? Liability is present obligation of an entity. In the present you have obligation to pay money, and this is arising because of a past event, and in the future it will result in outflow of resources. Arising because of a past event, present you have an obligation, in the future there will be cash outflow. That is liability. Got it? Past, present and future of liability. Then we'll discuss the next topic of types of liability: current and non-current. Again, same to same what we discussed for asset. If it fits within the operating cycle, current. If it doesn't fit within the operating cycle, then it is non-current. Operating cycle is subject to minimum period of 12 months. If the operating cycle is 9 months, then what do you take as accounting period? 12. What if the operating cycle is 18 months? 12. Subject to minimum of 12. You can, however, consider if it is 13 months, 14 months, if you think some item is current item, but just because of small comparison with 12 months, it is not. You get that? Sorry, 18 months is what you will take. If the operating cycle is 18 months and period is 12, whichever is higher is what you consider. I hope that's understood. Sorry if I told whichever is less at some point. Then after liability, next topic is owner's equity. Owner's equity talks about what belongs to owner. What belongs to owner is the capital that he had invested in the beginning, capital that is invested later as additional capital, profits that the business has earned for his sake, minus the drawings that he has made. Basically the money that the firm owes to businessman, money that he has given minus money that he has taken away, plus the money that business has to give additionally to the businessman. Initial capital plus additional capital plus interest on capital plus profit minus drawings whatever he has made is basically the capital or owner's equity. Have a look at this: amount invested by the owner initially or additionally. To this from this we deduct the amount that he has withdrawn already. To this additionally we add the profit that belongs to him. Then we'll ultimately get the amount that belongs to the owner's equity. I hope everyone got this. Then last two, one is revenue, other one is expense. Revenue is the sum value of all the benefits that the businessman has given by way of service or goods that he has sold. Against that he has to collect money. That becomes our revenue. What is revenue? Revenue, also known as income. Revenue is also known as income. It is value of all the goods sold or services rendered by the entity. It is value of all the goods sold or services rendered by the entity. Exactly opposite to this is expense. What is expense? It is value of all the goods purchased or bought or services taken by the entity. Value of all the goods bought or services taken by the entity. This is expense. Everyone got it? Fantastic. By this we're done with the basic part. One more thing that we need to know here is, why do we do accounts? In this part there are three parts. One is characteristic features, next one is objectives, and the last one is disadvantages or limitations. Objectives is to keep a systematic record of all the transactions that has happened in the business, to evaluate financial performance, to evaluate financial position, to know the profitability, and also to know the net worth of the business. And then comes three things. One, decision making. Based on this profitability and performance, you have to take decision. That is also helped with accounts. Next thing is, in order to know the solvency position, meaning at any point of time, if in case you close the business, will you have enough money to pay all the liabilities? That is understood by checking solvency position. And ultimately, what do? Astela, everything's over. Systematic record, evaluating financial performance, position, decision making, and to know solvency position. Yeah, all five. So this is the objectives of accounting. What are they? Systematic record, financial position, financial performance, decision making, and finally to know solvency position. These is objectives. What are characteristic features of accounts? Accounts functions are to help us measure. If not for accounts, how do you measure your profits? How much profit? This much. This much means how much? Yeah. So tell in numbers, no? That is measurement. Forecasting. You will tell, no, next year our profits are expected to be this much. Q3 results are expected to be this much. They tell in terms of numbers. That forecasting, predicting the future is based on the past data, which is maintained by way of accounts. Accounts will help us take decisions. Accounts will help us compare our results with some other business results. It can be within the industry, or it can be competitor, or it can be some other industry altogether, or it can be the overall country's performance. So you basically can compare your profitability or your financial position with some other business because of accounts. Evaluation. After you compare, you take one decision. No? My business is done better than their business. My growth rate is 2% more than the industry. My profit percentage is 1% higher than my competitor. You arrive at these conclusions. That is evaluation. And finally, all this will help you control your business. If your GP percentage is positive, your net profit percentage is negative, that means your indirect expenses are more. Your sales margin is high, but your asset expenses are more. That means you have invested too much money in assets. So basically, you can control your business by analyzing the information that is there in financial statements. A lot of them take decisions, no, whether to invest in the business or not by looking at the financial statements. Whenever you seek for investment also, someone will definitely ask your financial statements. So accounts will help you control your business. Finally, government regulation and taxation. It is not like our hobby to maintain accounts. Government wants us to maintain accounts. Companies Act wants you to file annual returns. Income Tax Act wants you to file income tax returns. And all these legislations put together have put a responsibility on us to maintain proper books of accounts, so that they get enough information to understand how the company is functioning when it comes to financial resources. Got that? That is functions. Lastly, we have limitations of accounting. What are the drawbacks or limitations of accounting? All the qualitative factors are ignored. We record only those items which are quantitative in number, and we also record only historical information. We don't give any consideration for the price change that happened after. Whatever was the price at which when we affected the transaction, that will be recorded. All the price level changes because of inflation are ignored. Accounts is biased because we can choose such a policy which will give the kind of profit that we want. And ultimately, you can fabricate accounts to make it look like how you want. So that is window dressing. You can inflate the profits, you can deflate the profits, show higher worth of assets when the actual worth is less. So when you can play around with accounts, trying to beautify it either to attract investor or to evade tax, that's what we mean by window dressing. And this is limitation of accounting. After this, then one last point that's there, this was asked in your recent RTP also, is what can you do after you qualify as a chartered accountant? Role of an accountant in the society. So there are several parts. Service part was what was asked in MTP or RTP, I don't know. MTP lita. MTP had a question. What is the service, what is the role of a chartered accountant in service industry, or what services can a chartered accountant offer? So as a chartered accountant, you can help people maintain their books of accounts when they don't know how to maintain accounts. You can help them audit their books. Auditing can be internal audit, auditing can be statutory audit. And you can help them in consultancy. tax consultancy, management consultancy, meaning how much tax to pay. You can help them identify. If they don't know how to manage their business, you can help them. You can help them in arbitration. Arbitration is settling the transactions outside the court if there is a conflict. Or if they want to start a business, they don't know how to incorporate a business, how to get the certificate of incorporation. If you want to create a partnership firm, where to apply. So they don't know all of that. So all of that is a service what a chartered accountant can definitely offer. And you can help them plan their money, financial planning and advisory, treasury management, taxation. All of this is the work what a chartered accountant can offer as a service. This was the question in MTP. However, if you don't want to get into service sector, you can get into something called industry. You can go seek employment. In what fields can you seek employment? Can you seek employment in engineering department? No. You can seek employment in finance department, accounting department, costing department, treasury, budget. These are our core areas. We can seek employment here. If you don't want to seek employment in industry, you can work in PSU. By PSU, I mean public sector undertaking like BHEL, HAL, BEL are there, no? So there again you can work in such public sector undertakings. So all of these public sector undertakings, when you work, there also will work in same department, finance department, budget department, accounts department, audit department, reporting department. This is where we can work. Or we can become entrepreneur. Entrepreneur agbeku anta you can decide. Then if you become entrepreneur, you can help in country economical growth of the country. Or you can decide to help the government frame their fiscal policies. Usually in the financial year beginning or before the financial year, they come out with budget. The finance minister of the country and the state comes out with the budget. So when they come out with the budget, there is a huge team which sits behind and then makes the policy, financial policy for the country. So you can be part of a team that frames the fiscal policy of the country. That is helping trade, commerce, industry or public goods and service. Or like I told you, you can become entrepreneur and then you can contribute to the economic growth in your own way, whichever way you want. You can open sandwich gardi if you want, or you can put chai business, whatever business you want, and you can still contribute to the economy of the country. So this is our introduction to accounting unit in theoretical framework. Got that? Next we'll do concepts and conventions. We have 2 more units in this, concepts and conventions. After that we will be discussing capital revenue and valuation principles, including introduction to accounting standards. First chapter is going to go a little flat and you guys would have to deal with it. If you try to do it by yourself, it's more difficult. You wouldn't be able to do it at this speed. So trust me, it's good that you people force yourself to do chapter 1 to 3. Please don't skip easy topics, so please don't skip. Let's start with concepts and conventions. Shall we start with accounting concepts and accounting conventions? First we'll discuss accounting concepts. What do you mean by an accounting concept? Concept is an idea. Concept is an idea means it should glow. It's an idea, or we can call it notion also. This should have universal acceptance. It is an idea which has universal acceptance, and this is followed in preparation of financial statements. 3 things to remember. 1, idea. 2nd, universal acceptance. 3, used in preparation of financial statements. So if you remember that it's an idea which has universal application and it is utilized in preparation of financial statements, then it is accounting concept. 3 images: idea, bulb; 1, globe; 3, paper. Idea having universal application, which is a primary assumption based on which financial statements are prepared. How many of them do we have? We have 10 of them. How many of them? To begin with, entity concept, then we have money measurement, periodicity, accrual, then matching, going concern, cost, realization, dual aspect and objective evidence. Let's start with going concern concept. It says that an organization neither has an intention nor a necessity to close down its operations in the near future. It says an organization neither has an intention nor a necessity to close down its operations in the near future. We prepare balance sheet because of going concern concept. We close our shop today with an intention of opening the shop tomorrow. So when we close our shop today, whatever is there inside the shop will be written in our balance sheet because we'll use them next year. If you don't have an intention to open the shop tomorrow, what do? You sell everything that's there in your shop today. The difference between current and non-current is also there because of going concern concept. There was a question on this in your recent RTP. They had given an item, they told an organization is not a going concern. If it is not a going concern, then how should they value their assets? If the organization is going concern, they'll record the assets at historical cost. If the organization is not a going concern, then we'll record the asset at its realizable or fair market value. There was a question on this in our recent RTP, if I'm not wrong, and a question on this concept had come in your recent CA Intermediate May 2024 examination also. They had asked to prepare balance sheet of a company when there is no going concern. So then what do? Fixed assets also will be recorded at fair market value or realizable value, not at historical cost. And all the liability should be recorded at realizable value, the money that you should pay, settlement price. They have to record them at that price. So that's going concern concept. The balance sheet of a company is prepared because of going concern. If not for going concern, there would be no balance sheet. Then we have periodicity concept. Periodicity concept says that the entire life of the business, which is really long, will be broken into smaller pieces, and each small portion or each small piece is called as accounting period, and we prepare financial statements for each of that accounting period. So periodicity concept says that entire life of a business is divided into smaller portions called as accounting period, and books of accounts or financial statements are prepared for each of the accounting period. Got it? This is also called as accounting period concept. What is the other name for this? Very good. So then we will discuss entity concept. Entity concept says that an organization is distinct from its owner. An organization is distinct from its owner. They both are two different persons. They are not the same. An organization is distinct from its owner, and that's what we mean when we say entity concept. The personal affairs of the owner and the business affairs are very distinct. They are definitely not the same. And capital invested by the owner is a liability to whom? To business, because they have to pay it back to the owner at the end of the day. However, from the owner's perspective, that capital is asset, because the owner can receive that money back from the business at the end of the business. So the same capital which is liability to business is actually asset to owner, because they are distinct persons. They are not same. Business, owner are distinct and very. Okay. What do we have after this? Then the next discussion comes to money measurement concept. Money measurement concept is that if you want to record a transaction in books of accounts, it has to be written in terms of monetary value. It has to be written in terms of monetary value. If you cannot measure it in terms of money, it cannot enter into your balance sheet. So monetary measurement is very important. Money measurement concept is that transactions to be recorded in books of accounts should be measured in terms of money. Transactions to be recorded in books of accounts should be measured in terms of, what is it? Money. Why money? Why not any other numbers? Because it is of standard economic value and there is universal acceptance, and we basically use it as a medium of exchange, so we write it in monetary terms. You cannot write in kgs, quintals, liters. You get it? Money is standard unit of measurement, universally accepted. What is after money measurement concept? Accrual concept. What does accrual concept say? It says that we should record transactions and the transaction happens. We don't wait for actual affecting of the transaction in cash. Certain times transactions happen now, cash is affected later. So we should record it now and we should not wait for the cash to get affected. So record the transactions as and when it happens and not merely when it is affected in cash. Record the transactions as and when it happens and not merely when it is affected in cash. Today you purchase the goods, you pay the money after 1 month. Today you should record purchase entry though you didn't pay cash. Today you should record the purchase entry though you did not pay the cash against the same. After accrual concept, like I told you, accounting can be two bases. One is cash and the other one is accrual. Business entity should follow accrual basis. Business entity should follow accrual basis. Then after accrual concept, next we have matching concept. Matching concept says that we need to match. What should we match? Our current year expense with our current year income. We need to match our current year expense with our current year income. When we match our current year expenses with current year income, if income is more, expense is less, it will become profit. If expense is more, income is less, it will become loss. Imagine P&L account here. I'm writing all the expenses here. I'm writing all the incomes here. I'll match my current year expenses with my current year income. Income is more, expense is less, profit. Expense is more, income is less, loss. And when we match, we should use current year. We cannot take last year profit, current year expense, or current year profit, next year expense. If you take current year expense, current year income, when we match, we get current year profit. Correct? That's matching concept. Matching concept is possible because of accrual, and it's also possible because of periodicity. If not for accrual, let's say the expense is incurred this year, paid next year. Accrual concept forces us to write the transaction in this year, because of which matching is possible. If we don't write the transaction this year, let's say we write the transaction next year, then current year expense is not recorded in current year. How can you compare current year expense with current year income to find current year profit? And breaking that entire life into periods is because of periodicity. So it is based on two things. One is periodicity, second one is accrual. Got that? That's with regard to matching concept. And after we finish matching, then we'll go to cost concept. What do we mean when we say cost concept? Cost concept says that whenever we purchase an asset, we should pay money for the same. The price that we pay is cost, and cost is the price at which we should record. What is it? Cost concept says that whenever we acquire an asset, the money that we pay is cost, and the cost is the value at which we should record the asset. What is the price prevailing in the market? Doesn't matter. We record it at the price that we pay. See this, value of an asset is determined based on historical cost. Historical cost is the amount that we paid when we purchase. This is what is usually followed when there is going concern. However, when an organization is not a going concern, when it is going to be liquidated very soon, we don't have an objective of holding the asset for long. We will sell it. Because we are about to sell the asset, we will record it not at historical cost, but we will record it at realizable value. When there is a going concern, how do we record the assets? Historical cost. When there is no going concern, we will record the assets at realizable value. And there are a lot of other valuation principles, replacement price, and then say a fair value, or realizable value. All of this we'll discuss that later. Current cost, we'll discuss that later in the same chapter towards the end. So like I mentioned, if there is a going concern, historical cost. If there is no going concern, then realizable value. Talking about realizable value, we'll move into realization concept. It says that assets should be usually recorded at historical cost. That is when the organization is a going concern. If it is not a going concern, there is something which is completely opposite to historical cost method. What is it called as? Realization price method. This says that record the asset not at the price that you paid, but record the asset at the price that you will get if you sell. Record the asset not at the price that you bought, but record the asset at the price that you get if you sell. That is realization concept. When do we follow realization concept? When there is no going concern. When there is a very good, then it is now accepted because revaluation of PPE is allowed. Then we have something called as revenue recognition concept, which is actually not part of your syllabus, but let me just reiterate that part to you. Should recognize revenue on sale of goods when there is transfer of three things. 1. Risk. 2. Reward. 3. Effective control. You will recognize revenue on sale of goods on transfer of three things: risk, reward, and effective control. This is with regard to revenue recognition concept. Previously, under the old scheme, CACPT, when the ICI had issued the material, no, this was there in that. However, in the new scheme of education, when the new syllabus material has been issued by ICI, in that new syllabus, there is no concept of revenue recognition in the material. We'll still read that. Realizations of the revenue recognition. I'll just tell it. Then dual aspect. This is the basis for accounting equation. We write no assets is equal to liabilities plus capital, or the entire debit credit logic is based upon this. This dual aspect concept is that every transaction what we deal with will have two aspects. Every transaction what we deal with will have how many aspects? Two aspects. And as a businessman or as an accountant, when we identify the transaction, we need to recognize both the aspects of the transaction. We need to measure both the aspects in terms of money, and we should record both aspects. So dual aspect concept says that every transaction will have two aspects. We need to recognize, measure, and record both the aspects of a transaction. Have a look. Every transaction or event will have two aspects. We need to recognize, measure, and record both the aspects. Accounting equation assets is equal to liabilities plus capital is possible because of dual aspect concept. This says that whenever an asset is increasing, it will lead to decrease in another asset or increase in liability. If there is decrease in any asset, examples I think I can skip. If in case there is decrease in an asset, it will lead to increase in another asset or decrease in liability. Example can be cash paid against a loan. Then if there is increase in a liability, it will result in decrease in another liability or increase in an asset. Finally, if there is decrease in a liability, it will lead to increase in another liability or decrease in asset. Let me repeat. Increase in one asset will lead to decrease in another asset or increase in liability. Decrease in one asset will result in decrease in another asset or increase in liability. If there is increase in liability, it will lead to decrease in another liability or increase in another. No. If there is increase in liability, it will lead to decrease in another liability or increase in asset. If there is decrease in liability, it will lead to decrease in an asset or increase in another liability. Did I tell wrong at some point? But I corrected it. Now it's all fine. No doubts on this. Then zooming into the next topic, objective evidence, which is the last concept. This is also given in blue because again this concept is not there in your material. Objective evidence. What does it say? Every transaction, whenever we're going to record it in books of accounts, we should check whether that is an authentic transaction. How do we check? Or why do we check? We check to know whether it is business transaction or not. So to check it, we need some evidence. That evidence should prove the objective of the transaction. So every transaction that we deal should have an evidence supporting the transaction. That is what we mean when we say objective evidence. Every transaction should be backed by an evidence proving its objective. Bill, invoice, voucher, anything can be there. Got this? This is the last concept. Concepts and conventions are not same. Concepts are different, conventions are different. Concepts are fundamental assumptions based on which we start making financial statements. Conventions come in the process of accounting. Concepts are fundamental assumptions based on which accounting is done. Financial statements are drafted. In the process of drafting the financial statements, what will arise or what will come by usage and practice is conventions. So these are the practices that has come over a period of time. Got it? How many conventions do we have? We have 4 of them. Number 1, conservatism. Number 2, consistency. Number 3, materiality. And number 4 is full disclosure. When we say conservatism, it says that we need to record a transaction. We need to record a transaction relating to expense or a liability, even if it is not affected in cash, even if it is going to be in the future. If we expect it, we should record it. However, if you expect a profit, if you expect an asset as a result, don't record it. Wait for it to actually happen. So we need to record for all expected expenses and losses, but not for expected incomes and gains. What does conservatism say? Account for all expected expenses and losses, but not for expected incomes and gains. This will actually result in overstatement of assets. This will actually result in understatement of assets and overstatement of liability and understatement of wealth, but can't help it. So it will result in understatement of income and wealth, and it will result in overstatement of liabilities and expenses, but that is okay. Only thing that you should keep in mind is prudence. You should do practically. You cannot be biased, or you cannot be with an intention of window dressing to do this or to show higher profits. This concept or convention of conservatism needs to be followed based on prudence, neutral mindset, and faithful representation of your financial statements, with the intention to show your financial statements in a very fair way. Got it? Then after conservatism, we have another thing called consistency. What does consistency say? It says that the accounting conventions or accounting policies that we follow should be same from one accounting period to another accounting period. We can't keep changing. This year I'll follow some accounting policies. Next year I'll follow some other accounting policies. You can't keep changing them. You have to follow the same accounting policies and practices from one accounting period to another accounting period. That is consistency. Can we break consistency? we are allowed to change our accounting policies. We are allowed to change our accounting policies, but the exceptions are given in accounting standard 1. We'll discuss that there, and for now let's slightly go forward. Consistency will enable comparability. If there is no consistency, what will happen? You yourself are following different things every year. How can you compare your previous year profits to current year? You cannot. In order to compare your previous year profits to current year, previous year and current year accounting policies and practices should be same. If policies and practice are different, and if there is difference in profit, that profit difference is arising because of change in accounting policies, no? That cannot tell you about your results. We'll discuss policies later, and the periodicity will enable consistency. If not periodicity, you cannot break entity into years, no? Then how can you check consistency between years? Then we have materiality. As per your materiality is the last convention. What does materiality say? Materiality says that all the facts and figures which affect the decision making of the user has to be disclosed separately. And that's what we mean when we say materiality. All the facts and figures that have significant economic value and will affect the decision making. If that information is told to a person, the kind of decision that will take will be different. If that information is not told to him, then the decision that he will take will be different. So if that data or information can decide the decision making, it can help person take a decision, then it is called as material. If it doesn't let him take decision, then it is called as immaterial. All the material information which will affect the user has to be disclosed separately, and immaterial items need not be disclosed. That is as per materiality. However, there is one more convention called full disclosure, which was previously part of your book, now not there. What do they say in full disclosure? They say it doesn't matter whether it is material or immaterial, you still have to disclose it. It doesn't matter whether it is material or immaterial, you still have to disclose it. Isn't there a conflict between materiality and full disclosure? Answer is yes. Materiality says disclose only material items. Full disclosure says disclose material items as well as immaterial items. What do we do? Which one to follow? We should follow both. We should follow materiality for disclosing all the material items. Immaterial items will also be disclosed, but not with the same element of detail. Immaterial items can be just disclosed at one place. Material items will be disclosed on the face of the financial statements, in bold, in italics, catching all the attention, giving necessary disclosures. Immaterial items all together at one place, saying that these are also the disclosures that we're making, but these are not material. Are you getting it? By this, we finish accounting conventions and accounting concepts. There are two concepts and one convention which is regarded as fundamental accounting assumptions. What are they called as? We need this for later, so I want you to remember. How many accounting concepts? 2. How many accounting conventions? 1. What are they? Going concern, accrual, and consistency. Going concern, accrual, and consistency are 3 of them which are called as fundamental accounting assumptions. Fundamental accounting assumptions. So what do you mean when you say fundamental accounting assumptions? I will get back to that part when we do the next unit. So we're done with 2 units, and another 15 minutes max we will finish this unit. Next unit, remaining part of our chapter 1. The third unit is on accounting cycle, which I am not doing right now. The reason being, whatever is there in accounting cycle is again repetition in accounting process. So we'll cover it up there. In a regular class, we do it in separately only. But because these units are overlapping one with the other, rather than repeating, I would choose to do it in accounting process topic. Considering that this is marathon revision and hoping that you people have done your reading before attending the marathon revision session. Usually people watch it at 1.5x speed. Do you really have the guts to watch this video at 1.5x? Usually that's what you do, no? Whenever you see a video of 1 hour, say 1 hour video means I can finish in 40 minutes. Why? Some part I will scroll, drag it forward. Some part I will watch it, double tap and forward. Some parts what will I do? I will watch it at 1.5x. 2x, huh? Really? Surprising. 1.75. Yeah. Possible 1.5 this? I am only going at 1.5. Capital or revenue. So this is helping us decide whether a transaction is a capital transaction or a revenue transaction. In this context, when we say capital, we are not meaning capital which is like reserves and capital, opening capital, additional capital drawings. No. It is capital receipt, capital payment. It is capital receipt, capital payment. It is not that capital. And when we say revenue here, it is not income, like sum of all expenses, benefits given or goods sold against which money is supposed to be received. Not that revenue. Here when we say revenue, we mean revenue receipt, revenue payment. When we say capital, we mean capital receipt, capital payment. When we say revenue, we mean revenue receipt, revenue payment. Got it? Now, what do you mean by capital receipt? Or how do you pick a transaction and tell whether it is capital or revenue? There are certain bases. The basis is number one, nature of business. What is the number one? Nature of business. Let's say you bought a building. It can be a capital payment if that building is used for office purpose. However, you are a realtor, you are a real estate dealer, you buy and sell properties. Then you bought a property. Then the same payment what you paid for the building will become a revenue payment. So nature of business will decide whether a specific payment is capital or revenue. You paid money to buy a car. That car is used for your business purpose, for you to commute between your office or commute with, say, from one office to another office. That is a capital payment. However, you are a car dealer. You buy car, you sell car, you buy car, you sell car. Hyundai ಬೇಕಾ ಸರ್, Hyundai i20 20,000 ಇದೆ ಸರ್. ಐಕಾನ್ ಬೇಕಾ ಸರ್, 40,000 ಯಾರು ಕೊಡೋದಿಲ್ಲ ಸರ್, ರಿಜಿಸ್ಟ್ರೇಷನ್ ಆಲ್ಸೋ ಫ್ರೀ. ಸ್ವಿಫ್ಟ್ ಡಿಸೈರ್ ಬೇಕಾ ಸರ್, ಇದೆ ಸರ್. XUV ರೆನಾಲ್ಟ್ ಡಸ್ಟರ್ ಬೇಕಾ ಸರ್, ಇದೆ. So someone is selling cars like that. For him, that payment what he makes for sale of the car, purchase of the car, that payment what he makes when he purchases the car, that receipt that he gets by sale of the car is all revenue. However, you buy car for your office purpose or you sell your office car. You are not a dealer in cars. Then you purchase and sell car. That payment or receipt is capital. If you are a dealer in car, it is revenue. Do you get it? Say something. Very good. So first one is nature of business. Next one is purpose. What is it? Purpose. When you buy it with an intention to sell, when you buy it with an intention to keep, that will help us decide. Maybe you are a real estate dealer, but you bought a building for your office. Just because you are a real estate dealer, the moment you buy a building, it will not become revenue payment. If you bought that building with an intention to make it into your office, that will become capital. Got it? You are a car dealer. You bought a car. The moment you buy a car, it doesn't become revenue payment. What if you bought that car for your office purpose, for you to use? Then it will become capital. Got it? So first thing is nature of business. Second one is purpose. Third thing that we should note is recurability. If a specific payment or receipt is recurring in nature, it is revenue. If it is not recurring in nature, it is capital. Recurring is repetitiveness. And what is the frequency of that transaction happening? If it happens very frequently, very repetitively, very often, with less gap between time, revenue. If it doesn't happen usually, if it happens once in a blue moon and it's a long form transaction, capital. This is not the only three consideration. We have one more, materiality. If the amount paid or amount received, if it is material, if it is significant, it can affect decision making, then it is capital. If it is negligible, if it is not going to be big, if it is not going to let you take decisions, then it is revenue. So materiality is also a factor to decide whether it is capital or revenue. And the last point is revenue generation capability. If you make payment, against that payment you get a specific asset. That asset has a capability to generate revenue income to you. Then that payment is not revenue. If a payment that you make will give you benefit in long run, if it's going to create revenue income to you in the future, that payment will not be revenue. That payment will be capital in nature. Got it? So if it is going to give revenue in the future, that will not be revenue, that will be capital. So this is the basis to decide whether a transaction is capital or revenue. Why are we classifying the transactions into capital and revenue? Why should we classify? Because the accounting treatment is different. If a specific transaction is revenue in nature, it will go to P&L account. If it is capital in nature, it will go to balance sheet. And you need to be cautious with regard to one item called deferred revenue item. What is deferred revenue item? Looks like capital, but it is actually revenue. Looks like capital, behaves like, it's actually revenue, but behaves like capital. If you pay some 10 years, 3 years, 4 years expense together, prepaid insurance, prepaid rent, you might feel like it's capital item. It is actually not capital. It is revenue for several periods written together. What should we do? To the extent it relates to current year, we'll treat it like revenue. To the extent it relates to next period, we will treat it like capital. It's not capital. We'll treat it like a capital item by writing in balance sheet. Let us say we paid rent for 18 months. We should pay rent for how many months? We paid rent 18 months. In the 12 months is current year, 6 months is next year. To the extent it relates to 12 months, it is revenue expense. It will go to P&L account debit side. To the extent it relates to 6 months, benefit will be taken in the next year. So you defer that 6 months of rent to next period. We'll write that 6 months rent in balance sheet of current year, and in the next year you shift from balance sheet to P&L. So you are deferring of postponement to P&L. Though you paid 18 months rent in current year, you are not writing 18 months rents to current year P&L. You are writing 12 months rent to current year P&L, 6 months rent in current year balance sheet, and in the next year from the balance sheet you will shift that 6 months rent to P&L account. That is deferring the revenue. Got it? Ultimately, after this, then we'll go to accounting policies. Like I told you some time ago, accounting policies and practices should be consistent from one period to another period. There, when we told accounting policies, what do we mean by accounting policies? It is principles which are the basis of preparation of financial statements. What are accounting policies? It is principles and methods of applying those principles in preparation of financial statements. Whenever you have to value your inventory, you have FIFO, LIFO, SAM, WAM. Whenever you want to value your fixed assets, you have cost model, revaluation model. Whenever you have to find goodwill, you have simple average method, weighted average method, annuity method, super profit method, capitalization method. So you have multiple options, multiple principles, what you can pick. And these are picked and applied in preparation of financial statements. They are called as accounting policies. I have given examples also. Got it? There is a big problem because of this accounting policies. What is it? Too many to pick, no? Too many options. What if you pick wrong option? What if you pick wrong option? What if you pick the option which is not appropriate to you? Then what happens? There is no comparability, there is no reliability, there is no standardization. You follow one policy, I will follow one policy. Both of us didn't follow same policy, profits are different. We cannot say the statements are prepared based on different policies. Can we compare our profits? No. Is there some standard rule that everyone is following? No. And you are looking at some company's balance sheet or PL. You can't even trust that. Why? You can trust that balance sheet only based on the accounting policies that they follow. You buying food on the street side. You can trust and eat that food only if you know the ingredients. If the ingredients that they are using is not standardized, if they are using engine oil to do bhaji, you're like bhaji ontara different ide, chenagide, but you won't know that what is happening. So you should be able to figure out the ingredients. There should be standardization. That is where accounting standards will come. But before that, what is the cons of accounting policies? No comparison, no standardability, no standardization, no reliability, no uniformity, and there is only one thing, which is difficulty in selection. You don't know which one to select. These are the problems of accounting policies. To overcome all of these problems is a solution called accounting standards. These accounting standards are issued by ICAI, Institute of Chartered Accountants of India. ICAI, using all its powers, has issued 32 accounting standards, among which 30, 31, 32 is removed. Accounting standard 6 is been withdrawn. Accounting standard 8 is been withdrawn. So 6, 8, 30, 31, 32, 5 are not there. So 32 minus 5, 27 is the accounting standards that we have in force right now. But what is accounting standards? Accounting standards are written policy documents. What are they? These are issued by 3 authorities: government, expert accounting body, or other regulatory body. Whenever they issue these accounting standards, they cover the aspects of recognition, measurement, presentation, and disclosure. So remember to start with Akshay Kumar, accounting standards. Then Shah Rukh Khan are written policy documents. Cover it up with Disco Diwani, covering the aspects of recognition, measurement, presentation, disclosure. So accounting standards are written policy documents issued by government, expert accounting body, other regulatory body, covering the aspects of recognition, measurement, presentation, disclosure. Sums of the definition of the word accounting standards. In this, when I say government, I mean MCA, Ministry of Corporate Affairs. They issue accounting standards for companies. We'll learn it in inter when you come there. Expert accounting body means ICAI, Institute of Chartered Accountants of India. Institute of Chartered Accountants of India, when it issued accounting standards, the objective is to overcome the disadvantages of accounting policies. Accounting policies, we said no comparison, no standardization, no uniformity, difficulty in selection. objectives, bringing in standardization, bringing in uniformity, bringing in comparison, bringing in reliability, and making it easy to select. Making it easy to select. See, exactly ulta of what you had there. Uniformity, comparability, standardization, reliability, ease of selection. But one thing that you need to remember is, no matter what accounting standard says, it cannot override law. It cannot override law. And in spite of accounting standards are there, still we'll have choices. Still we'll have choices. Choices will become less. If you have 4 options, AS will tell you have to pick one among 2, but still 2 options are there. So it will still be a difficulty to make choice, but number of options is definitely reduced. So this is objectives of accounting standards. We have 2 simple parts of accounting standard that needs to be discussed. Standard setting process, you can do it yourself. This is the process. Then we have the list of standards. There I go, I'll take you to accounting standard 1, disclosure of accounting policies. About 10 minutes ago, I told you something, no? Exceptions for consistency, that is covered here only. Now, with regard to accounting standard 1, disclosure of accounting policies, there are 3 things that you should remember. 1, fundamental accounting assumptions. I told you, no? In concepts and conventions, 3 things I made you mark. I told you fundamental accounting assumptions. They are the 3 things. Going concern, accrual, consistency. What about it? Why is it called fundamental accounting assumptions? Very simple. Read the name very clearly once again. What does the name say? Disclosure of accounting policies. Disclosure of, what do we mean when we say disclosure of accounting policies? Whatever accounting policies the organization follows, they would have to disclose it. Whatever accounting policies an organization will follow, they would have to disclose the same. That is disclosure of accounting policies. However, if your entity is going concern, if your entity is following accrual system of accounting, if your entity has consistency in accounting policies, you don't have to make any disclosure. You don't have to make any disclosure. Disclosure is required only if it is not a going concern, there is no accrual, and there is no consistency. Against going concern, accrual, and consistency, no disclosure is required. Got it? That is the reason it's called as fundamental accounting assumptions. After this, we have changes in accounting policy. This is exceptions to consistency. Consistency says no, accounting policies and practices should be consistent from one accounting period to another. Can we change them? We can change our accounting policies. We can change our accounting. That is called changes in accounting policy because of exceptions to consistency. There are 3 situations in which you can change. When the accounting standard is changing, when the law is asking you to change, or if the change in accounting policy is going to result in better presentation of your results. Let me repeat, when can you change your accounting policy? You can change your accounting policy in 3 cases. When requirement is there by law. Second one, when there is change in accounting standard, or if you think such a change in accounting policy will result in better presentation of your results. Got it? Then we have considerations for selection of accounting policy. What is the consideration? How do we pick accounting policy? When we have more than one option to pick, how do we pick one among these 3-4 options that we have? That is what we mean when we say consideration. AS1 doesn't tell which accounting policy to pick. AS1 will tell what to consider if you want to pick. It says you need to be considering prudence, substance over form, and materiality. What should you be considering? Prudence, substance over form, and prudence is you need to be practical when it comes to accounting. You cannot be blindfolded, or you cannot be neutral. You cannot be inclined to one part. You should be neutral. You should not be inclined to show higher profits. You should not be inclined to show lower profits. Prudently, practically, vigilantly, professionally, you will think and then take the decision. That is prudence. Substance over form means accounting reality should be given more importance than mere legality. What should you give more importance? Reality in accounts should be given more importance than legality. You purchased one asset, agreement is signed, money is given, asset is taken, but registration is pending. Doesn't matter. Legally, the old person, the other person, seller is still the owner. You are not the owner. Why? It is not registered with the registrar, but you paid the consideration, sale deed is signed, asset is received, you have taken control, possession of the asset, you record it as your own asset and charge depreciation. Even if it is still registered legally in the other person's name. Why? We go by reality. substance is more important than the legal form for us. Or lastly, materiality. So these are the three important considerations based on which you will recognize, you will record, or you will pick a accounting policy. This is accounting standard 1. Accounting standard 2 you will read in chapter 4. Accounting standard 10 you will read in chapter 5. Accounting standard 26, the reference is there in chapter 8. Then the last standard that you should learn is provisions. Once you do provisions, this is actually a separate unit in your material. We have only valuation principles to discuss. Once we are done with that, we'll be done with chapter 1. I'll give you a short break the moment we finish our chapter 1. It's another 5 minutes. Can I? We didn't take long, 1 hour 20 minutes for entire chapter 1. What do you mean by provision? What do you mean by contingent asset? And what do you mean by contingent liability? So here you have definitions, 3 of them: provision, contingent liability, and contingent asset. I'll break this definition down to you and then make it more simple to understand. Whenever we start understanding provision, contingent asset, contingent liability, first you need to know the meaning of the word contingency. Contingency is an event which is dependent upon happening or non-happening of one or more future events. So it is an event which is dependent upon happening or non-happening of one or more future events. So future uncertainty and uncontrollability is the consideration. For example, RCB getting qualified to playoffs was a contingent event. It can happen, but it cannot happen also. I'm not talking now, talking about 1 week ago, 10 days ago. It can happen, or there was a possibility that it cannot happen also. It was in future that the decision will be coming out, and it is not in our control. Why? It is not like we will win all the games and we'll go to playoffs. We have to win, they have to lose, that match rain has to come, this match this guy has to be out. So a lot of things had to happen and everything went our way. So things were not controlled and no one was sure. No one was sure, but still one thing was very, very sure. Isala namde. Okay, so contingency is an event dependent upon happening or non-happening of one or more future uncertain and uncontrollable things, and that's how we decide contingency. You get this? This contingency, when it results, it can result in outflow or it can result in inflow. If this contingency is resulting in flow of economic benefit, that is going to result in asset. If it is going to result in outflow of resources, we call it contingent liability. Let me repeat. If the contingent event results in inflow, it is asset. If it is going to result in outflow, it is liability. Not a normal asset or liability. It is a contingent asset or a contingent liability, meaning it can become an asset in the future. It's not an asset right now. It can become a liability in the future, not a liability right now. So this contingent asset and contingent liability, it should not come to balance sheet. Why? Balance sheet is for assets and liabilities. You should disclose them outside. Contingent asset and contingent liabilities should not come to balance sheet. It should be disclosed outside balance sheet. However, contingent asset should not be disclosed also. There is no need of disclosure also. Why? Prudence. What is it? Prudence. If it becomes asset, we will record. If it is not an asset, no need of disclosure also. Further, for a contingent liability, we create provision. For a contingent liability, we create contingent liability means in the future there might be outflow. Conservatism. Prudence. We have to make provision. But to make provision, it should fulfill 2 conditions. How many conditions? Number 1, there should be probable outflow. Number 2, there should be reliable estimate. Meaning probably this will not go in our favor. This will go against us. We would have to lose it. Probably there's going to be outflow of resources because of this. And second one, reliably you are able to measure how much is the amount of money that's going to go. So this particular event, which is now a conspiracy, will result in contingent liability to liability. I am expecting it. And when it becomes liability, I have to pay money. And I am able to measure how much money. So when there is reliably estimate of outflow and there is a probability that it will result in outflow, then for a contingent liability, we create provision. If it is contingent liability, only disclosure. If it is a provision, then we would have to make expense in P&L account and also liability in balance sheet. Do you get it? Says something very good. See, balance sheet ali, you will not write contingent assets and liabilities. Contingent liabilities will be disclosed in footnote. Contingent asset, no disclosure required because of prudence. If you make provision for a contingent liability, that is when it fulfills 2 conditions. What are they? Probable outflow and reliable estimate. You will shift that contingent liabilities from footnote to P&L expense and write in balance sheet liability side. Got it? This is with regard to provisions. Then last part, Ind AS is removed from your syllabus. We can skip this part. Last part of your chapter 1 is valuation principles. What is it? At the time when you purchased the asset long ago, what you paid is historical cost. At the time you purchased the asset in the past, whatever you had paid is historical cost. Then if in case you are buying the asset today, right now, what money do you have to pay? That is called as current cost. If you sell the asset now, what money will you get is realizable value. If in case you will use the asset and then take the economic benefits of it to the nearest future, to the longest future possible, the total economic benefits that you get is called as present value. So there are 4 valuation principles. How many? 4. Historical cost. What is historical cost? Long ago in the past, when you bought the asset, what you paid is historical cost. Today, if in case you buy a new asset of the same type, how much should you pay? That is current cost. If in case you sell this asset, how much money do you get? Realizable value. And in the future, using this asset, how much money or value are you going to generate? That is present value. Present value is the future may benefit what you get discounted to present value. So this is our valuation principles. And after discussing this valuation principles, last topic connected to valuation principles is accounting estimate. See, we did valuation principle. We can measure an asset based on historical cost, realizable value, current cost, or present value. But what if all the valuation principles fail? I am not able to identify the value of an asset. Historical cost is not there, replacement price is not there, future benefit. I am not able to assess current cost. I don't know. Then what do? We will record the asset at an estimated value. At what value? When do we do estimation? When we don't know the actual useful life of an asset. 10 years, 3 years, 4 years. How do you tell it? Estimate. At the end of the useful life, after 10 years, at what price can I sell this laptop? Realizable value. You can't tell anything actual. It is estimate. What is it? Very good. So that estimate is called accounting estimate. So accounting estimate, when do we do it? When we cannot measure an asset, when we cannot measure a liability based on valuation principles. When you cannot measure an asset or we cannot measure a liability based on valuation principles, then we do accounting estimate. Do you get this? Accounting estimate is being done based on 2 important bases. Number 1, past experience. Number 2, present situation. In the past, something similar had happened. From that, you gain some experience. In the present, whatever the situation you are in, you will analyze both and then arrive at accounting estimate. When you say useful life of a laptop, how many years is the useful life? 7 years, 8 years, 10 years. How do you conclude? In the past, you had a laptop. How many years was that laptop useful for? That laptop had lasted for 7 years. Okay. In the present, this laptop is better than the last laptop. Harder case. So it lasts for 1 year more than the old laptop. You analyze it to present situation and then you arrive at the answer. Last laptop, after 7 years of useful life, you sold it for 10,000 rupees. So now you bought one new laptop. What is the realizable value of this? You will check that laptop I had bought it for 50,000. I sold it for 7,000 after 10 years. This laptop I bought it for 2 lakh rupees. So when I sell it, I might get at least 30-40,000. So based on the past experience and the present situation, you will arrive at accounting estimate. What are the 2 important factors in accounting estimate? Past experience and present situation. Example is our depreciation, amortization, impairment loss, useful life, residual value, provision. When you say 2% provision for bad debt, 3% provision for bad debt, where did that number 2 or number 3 fall from? Estimation. It is just an estimate. Okay, that's it. By this we are successfully done with the topic of theoretical framework, which is chapter 1 of your syllabus. Ta-da! So it is about 4:52. Let's take a short break. It's not half an hour break. We'll take about 10 to 15 minutes break. We'll finish chapter 2 and then I'll give you one more, chapter 2 and 3, and then again I'll give you one short break of 15 minutes rather than taking 130 minutes break. I hope that's fine with you all. So it is 4:53, let's say 4:55. I'll give a short break of 15 minutes. See you all at 5:10. Yeah, around 6 o'clock, 6:15, we'll take another break once we finish accounting process and BRS. Oh, nice, man. How about you? For people who are watching it on YouTube stream, I will stop the streaming and I'll restart it in another 15 minutes. Let's quickly finish the second chapter. May or to say the easy part, journal ledger trial balance. Then we'll spend little time on one concept which is newly added with regard to GST. Once I finish the GST part which is newly added, then we'll do rectification of errors. Next break after BRS. Then after break, valuation of inventory and depreciation. Let's see, let's try and finish 1 to 5 today. Someone kicked no then. Hello guys, welcome back. We were discussing chapter 1. We have just finished chapter 1. Now let's continue with chapter 2, that is accounting process. Cool. When we talk about accounting process, it's the entire journey from being a transaction to be part of financial statement. So journey of a transaction from being a mere transaction to ledger to trial balance to final accounts. How is the entire journey going to be? So the journal is where we record the transaction the moment we spot it. The process of recording in journals is called as journalizing, and the order in which we record the items in journal is chronological order. This is the primary book of accounting where all the transactions are first recorded. It's also called as original book of accounts. From here, the transactions are then transferred to respective ledgers. How to pass journal entry? I don't think I would have to spend time. Should I tell how to pass journal entry? Identify the accounts involved, check whether they are increasing or decreasing. Then we should debit it, credit. I don't think I have to waste time around it. Should I? No. So then after this journalizing the transactions, then we'll go to ledger. Ledgers are called as secondary books of accounts, are also called as principal books of accounts. Once the transactions are entered in journal, from journal we post them to ledger. The process of writing the transactions in ledger are called as posting. Called ledgerizing is not the word, we call it posting. And when we write in ledger, we write them in the analytical order, not in the chronological order. Analytical is we analyze the transaction and write them in the respective ledger where they belong. Within the ledger, however, still the chronological order will be followed. At the end of the accounting period, we have two options. Should we balance the ledger or should we close the ledger by transferring it to P&L? This depends upon the type of the ledger. If the ledger that we're talking about is a real ledger, real account, or it is a personal account, these ledgers are balanced. Real accounts and personal accounts are balanced at the end of the year. That is, we write balance carried down and balance brought down in the next year. However, if the ledger that we're talking about is a nominal ledger, nominal account, then it is closed by transfer to P&L account. So real and personal ledgers are balanced, nominal ledgers are closed by transfer to P&L account. That's what you should note when it comes to ledgers. Then let's talk about subsidiary books of trial balance, and then I'll talk to you about trial subsidiary books later. After you prepare ledgers, each ledger will have balance. Whenever you start preparing financial statements, you need all the ledger balances. You can't keep going back to each ledger to pick the right amount of balance that you have in each ledger to prepare final accounts. So you take one place, and in this place you store all the ledger balances. Each ledger balancing figure, balance carried down or amount transferred to P&L. You write them all at one place. This summary of all the ledger accounts is called as trial balance. It is a place where you try to see if the debit credit balances are matching. So it is a trial to check whether it is balanced, and this is the primary source of information, or this is the basis what we will use to prepare financial statements. So when you start preparing balance sheet, P&L, trading and everything, you don't have to look into journal and ledger. Just keep trial balance at place and that will help. So trial balance is a statement which comprises of all the ledger balances. Why is trial balance prepared? The objective of preparation of trial balance is to check the possibility of arithmetical errors. Is there any arithmetical error? We want to check the possibility. And we want to simplify the entire preparation of financial statements. One place to go to. And it will work as summary of ledger accounts like I mentioned. Trial balance is prepared at the end of the year, or at the end of each month, or at the end of each week. When do we prepare trial balance? It doesn't matter whether it is end of the week, end of the month or end of the year. Whenever you want to prepare final accounts, you will prepare trial balance, because to prepare final accounts you need, very good, trial balance. So if you are preparing financial statements quarterly, you prepare trial balance also quarterly. If you're preparing financial statements annually, then you prepare trial balance also annually. So whenever you need to prepare financial statements, then you prepare trial balance. Trial balance can be prepared under three methods. How many methods? Total method, balance method, total and balance method. Let me tell you how does total method work. Each ledger, there are some items on the debit, there are some items on the credit. You won't find balancing figure. You will not find balancing figure. Ledger will not be balanced or closed. Let's say the total on the debit side is 10, total on the credit side is 12. You don't write 2000 balancing figure. Write 10 and 12 in trial balance. That is total method. What is balance method? Debit side it is 12, credit side it is 10. You identify balancing figure of 2000 on the credit side, that you will write in trial balance. That is balance method. What is total and balance method? There will be total debit, total credit column, debit balance and credit balance column also. I'll repeat. In a ledger, on the debit side the total is 12,000, credit side the total is 10. The ledger is not balanced. Now you need to write balancing figure of 2000 and close the ledger. We will not do that. I'll write 12 debit, 10 credit in the trial balance. That is total method. If I find balancing figure of 2000 on the credit side and then write that, that becomes which method? Balance method. However, if I open the ledger, summary of ledger accounts, that is our trial balance, write total debit, total credit, debit balance, credit balance as column. That is called total and balance method. In a regular class, I would have shown you with example how each of the method works. But I think now we can't afford to do that in detail. Can I go to the next one? Next we have subsidiary books. What do we mean by subsidiary books? These are alternative to journals. We do this instead of journals. Why? Journals are too lengthy. For a small business where the transactions are less, we can do journals. For a very big organization where the transactions are too many, we don't want to do journals. We cannot do journals. So then we have something special, which is something which does the work like journal, but it is not journal. These are called as subsidiary books. Subsidiary books are day books. They are alternative to journals. After you enter in journals, you need to classify in ledgers. No, they're saying instead of entering it all in one book and then classifying, at the time of entry only I'll classify into various categories. That is subsidiary books. We have several subsidiary books. Subsidiary books are primary books and are alternative to journals. Why do we prepare subsidiary books? The size of the organization is big. It is difficult to write it all in one book. Now I have one book called journal. Purchase entry in the same book, sale entry same book, cash entry same book, bank entry same book. In one book only one person can write. However, I will open 8 books. One book for writing only sales, one book for writing only purchase, one book for only cash, one book for all purchase return, one book for sales return, one book for bills receivable, one for sales payable, bills payable. Then what can I do? Then I can appoint 8 people. Each of them will handle one book. Then what will happen? Simultaneously 8 transactions can be recorded at once. If everything is in one book, I can record only one transaction at once. Do you get it? And when I appoint 8 people, I can divide the work among 8 people. They will become expert in the domain that they are working. And when there is some problem, I can check only that book. If there is some problem in cash transaction, I can only check cash book. If I don't do subsidiary books, I would have to check entire journals, which is actually difficult. So the advantages is it will help us divide work, it will help us get specialization and efficiency, and it will also save our time. And it will also give information like how we want and everything. Why do we prepare subsidiary books? Small business journal is suitable. For a bigger business, journal is not suitable. We need something special called as subsidiary books. How many subsidiary books do we have? Sales book, purchase book, sales return book, purchase return book, bills receivable, bills payable, cash book, petty cash book, and journal proper. What do we record in sales book? We record sale of goods on credit. If it is cash sale, we won't write. If it is credit sale but of asset, we won't write. It has to fulfill two conditions. Number one, it should be credit. Number two, it should be goods. What about purchase? Again, it has to fulfill two conditions. It has to be credit purchase of goods. If it is credit purchase of asset, we won't write. If it is purchase of goods but for cash, we won't write. So to write an entry in purchase book, it has to be credit and it has to be goods. To write an entry in sales book, it has to be credit and it has to be sales. If you have previously entered a transaction in sales book, that is as sale of goods. If that customer returns the goods to you, then you will write in sales return book. If previously the sale transaction is not recorded in sales book, why? Because it is cash sales. Then such sales return will not be written in sales return book. So entry is made in sales return book for credit sale of goods return. And entry is made in purchase return book for credit purchase of goods return. If it is cash purchase of goods return, will we write in purchase return book? No. What about bills receivable and bills payable? If in case you have done credit sales, you have sold goods to somebody who hasn't paid you money, they have to pay you money now. They'll give it in writing that they'll pay later. That in writing, whatever they give is bills receivable. All of that credits receivable, will write it in bills receivable. Similarly, when you have purchased goods, you owe money to somebody and you have given in writing that you have to pay the money, that is bills payable. After that comes cash book. In cash book, we write all cash transactions. In cash book, we write all cash, no mercy. Purchase, sale, sales return, purchase return, asset purchased, goods purchased, asset sold, goods sold, expense paid, income received. Doesn't matter whether it is expense or income. Doesn't matter whether it is current year expense or previous year expense. Doesn't matter whether it is purchase or sale. Doesn't matter whether it is income or expense, whether capital or revenue. The moment it is affecting cash, we write it in cash book. Then petty cash book. It is like younger brother of cash book. All the petty, small transactions will be written in petty cash book. The reason is the cash book where we will write all the big and important transactions cannot be the place where we write petty transactions. So under impressed system, we open petty cash book, wherein some money is assigned by the main cashier to petty cash. He will make all the small payments from that petty cash. If there is excess remaining in petty cash, it will be transferred to main cash. If the money in petty cash is over, from main cash money will be transferred, which will be utilized for the purpose of petty cash. Got it? Finally, we have journal proper. Journal proper is a place where we record all transactions which are non-cash, which are non-goods, which basically doesn't affect any of these above items, which doesn't go in any of this 1, 2, 3, 4, 5, 6, 7, 8, will go in 9. It's a residuary book. What is it? Final place where things will appear which cannot go anywhere else. That's our subsidiary books topic. And in subsidiary books preparation, whenever the question is given, they might give some transactions which are cash. They'll ask you to prepare purchase book. They'll give 4 transactions. One of it might be cash. So be cautious. If it is cash, don't write it. Or they might say it's an electrical business. They'll say furniture purchased. It is asset purchased. We should not write. And if in case they give normal credit purchase transaction, there will be adjustments based on trade discount. So remember, trade discount should be deducted. Trade discount should be deducted from the price and then written. GST is not there. Freight is usually not there. If freight is there, first to deduct trade discount, then add freight. First to deduct the trade discount, then add freight. Sir, what if there is GST? First to deduct the trade discount, then add GST, then add freight. Remember the order. Trade discount, GST, freight. Trade discount, GST, freight. Trade discount we should deduct. GST we will add. Freight we will add. Don't add GST on freight. Got it? That's with regard to all of these things. And once we are done with this, we need to have special notice towards our cash book. Can I spend a little time on cash book? Okay. Cash book can be prepared under multiple methods. How many methods? One is simple cash book, where only one column is there. Other one is double column cash book, wherein there will be two columns. What are those two columns? Those two columns can be cash and discount, can be bank and discount, can be cash and bank. There is nothing like two column cash book means cash and discount. Two column cash book means two columns. Which two columns? Can be any two. It can be cash and discount, it can be bank and discount, or it can be cash and bank. Three column cash book means cash, bank, discount. All the three will be there. In the preparation of cash book, remember, if there is a contra entry which affects bank and cash, amount deposited with bank, amount withdrawn from bank, it will appear in both the sides of same cash book. Then in the ledger folio column, you have to write alphabet C. If it is receipt in bank column, it will be payment in cash column. If it is receipt in cash column, payment will be in bank column. So be little cautious on this. And whenever you do cash book, another point to remember, checks received will be first treated as cash received. Later when the check is deposited into bank, then you will write it in the bank column. I'll repeat, whenever checks are received, it will be first treated as cash received. You will write it in the cash column on the receipt side. Then when the check is deposited into bank, you will reverse it by writing that amount in the cash column on the payment side and bank column on the debit side. I'll repeat, when the cash is received, you write in cash column. When the money is received through bank, you should write in bank column on the debit side. If the money received is in the form of check, you will not write in cash, you will not write in bank column, you will first write it in cash column. When the check is deposited, you will reverse this cash column debit by writing cash column credit. And again you will write in the bank column debit side. So you will straight away won't increase your bank balance. First you will increase your cash balance, and later when it is deposited into bank, then you will reduce your cash and increase your bank balance. Are you getting it? Always do this. Even if the check is deposited on the same day, for the sake of they being telling us to do this, you do it. Okay, it will take one line extra, 1 minute extra, not 3 months, 4 months extra time. So finish it in 1 minute. Clear? Yes or no? That's with regard to our accounting process. Now I would want you to understand the concept of rectification of errors. But before I go to rectification, a quick time on little bit on our GST part. Shall I? Very good. Come on. Let me do little bit on GST part. Because this has been little bothering to students, I thought I'll touch on GST. Till now there was no questions on GST, but this time they've added little on GST, that too not in your normal accounting. They've added it in final accounts. Because they've added in final accounts, people try to learn straight away in final accounts, which is difficult. You have to first learn journal entry, then you will go there. Shall I teach you the journal entry when the GST is involved? Yes or no? There is a question on this in our recent RTP also. In our recent RTP also, journal entries, there is one question and they've asked you to pass entry involving GST. Now, let us say sale. I'll tell the transaction and later we'll pass the journal entry. Sold goods for rupees 10,000 and GST on which SGST and CGST is charged at 5%. This is the question. Now what is the journal entry? Let's say the cash is received. Usually what is the journal entry we'll write? We'll write cash account debit. Am I right? We'll write cash account debit to sales account. How much is cash? 10,000. How much is sales? This is what we write as an entry. Now, whenever there is a sale, someone would have made profit. The person who makes profit needs to pay income tax on that profit. That is direct tax. Government has another way of collecting tax called as indirect tax. Indirect tax means the incidence and impact is not on the same person. Direct tax, incidence and impact is on the same person. You earn income, you earn profit, you pay tax, direct tax. You earn income, you pay tax. What is it? Direct tax. Indirect tax means what? You purchase goods from me. I will collect tax from you and I will pay to government. Incidence is on me, impact is on you. I would have sold the goods to you at 10,000. I will charge GST to you 10% on 10,000. 1,000 rupees I will collect from you. Impact is on you. Am I right? You will pay that 11,000 rupees to me, including 1,000 rupees tax. But I will pay that 1,000 to government. So incidence and impact is on two different people. That is called as indirect tax. A form of indirect tax what we have is called as GST, goods and service tax. Now you and me, we are sellers, we are our traders. So we write the journal entry, cash account debit to sales 10,000 10,000 when we collect 10,000 for sale of goods. Government is telling whenever you sell goods worth 10,000, you collect 1,000 on my behalf. That person has money to buy goods worth 10,000, he also has money to pay me. So you should collect how much? You should not collect 10,000. You should collect 11,000. Sir, how did we get 11,000? 5% SGST, 5% CGST. Together 10%. 10% of 10,000. 10,000 plus 10,000 into 10%. This is what you collect. 10,000 into 10% is how much? 1,000. You collect it along with 10, it becomes 11. Cash account debit 11. To sales account 10,000. Did you sell the goods for 10 or 11? 10. But you collected 11. What is this 1,000 extra that you collected? GST. Can you keep it with you? You should pay to government. You should pay to government. So this is called output. What is it called? You need to pay to government. It's called as output SGST. And similarly, we'll have something called as output CGST. How much is output SGST? How much is output CGST? 5,000. Sorry. Oh, sorry. How did you get this? 10,000 into 5%. And this SGST, CGST, whatever you collected, you should pay to government. You should pay to, what is the entry to pay to government? Same thing, output SGST account debit output CGST account debit to cash account. So this is for payment of the tax that you collected from the customer to government. Did you all get this? You should write this entry when you pay, but not for each entry. Now you sold 500 worth, you collected 500 worth of SGST, CGST. It's not like immediately you pay. You make the sales for the entire month. At the end of the month, you total GST what you collected, you pay. You don't have to pay transaction wise. You will pay in lump sum. Are you getting it? This is without the concept of input tax credit. Here comes the concept of input tax credit. What is input tax credit? See, whenever you sold goods, it means that you had purchased the goods. When you sell the goods, it means that you had purchased the goods. Let's say when you purchased these goods, what is the entry you had passed? Purchased goods. Let's say you didn't buy it for 10,000 rupees. You bought goods for 8,000 rupees. How much did you buy the goods for? And you also would have paid GST. Tell me what is the entry when you purchase the goods? Purchase account debit. How much did you purchase for? 8,000. I'll write here to cash account. How much did you pay cash? Did you understand this entry? Like you collected 500 extra here towards GST. The person who sold the goods to you, he also would have collected 5% on 8,000 extra from you. You end up paying him. So cash account will not be 8,000. Cash will be how much? 8,000 plus 8,000 into, you pay 5% two times. So you pay 10%. How much had you paid? You pay 8,800. So purchase is 8,000. What is the difference of 800? Here I called it output SGST, output CGST. No? Here this is called as input SGST and input CGST. How much is each of them? 8,000 into 5% and 8,000 into 5%. Can I say it is 400, 400? Do you guys get this? Tell me if you have any trouble in understanding this transaction so far. So when you sold the goods, you collected GST. When you purchased the goods, you paid GST. Now, whenever you are going to pay this 500,000 to government will tell you have an option of input tax credit. What do they say? Input tax credit. What do we mean when we say input tax credit? Government says, when you purchase the goods, already you have paid me 800. Like, I didn't pay the government, I paid to the person who sold the goods to me. He has paid to the government 800 rupees on my behalf. Am I right? So now when I collect 1000 rupees from government, I don't have to pay 1000 rupees to government. When I collect 1000 rupees on sale, I don't have to pay 1000 rupees to government. I will adjust it and pay only. Here I have collected 1000. I have already paid 800. I will pay how much to government? Only 200. That 800 what I adjusted is called as input tax credit. Did you all get it? Let me explain how it works. Now here, output SGST. Okay, output SGST is how much? 500. Output CGST is how much? 500. Correct. Then we have input SGST, input CGST. Input is how much? 400. After you adjust, SGST payable is how much? 500 minus 400. You need to pay 100. How much is CGST payable? 500 minus 400. How much should you pay? 100. So this is the concept that I want you to know. This is the concept which is new, which was not there in your syllabus all these years, which has been newly added. And I'll show you how the impact of this will be there in the financial statements also. Done. So when you pay that 100, what is the entry? Think and tell me what is the entry? SGST payable. No. We have input and output. These ledgers have to be adjusted. Your output SGST, output CGST is credited. I will debit it. I'll write output SGST account debit, output CGST account debit. 2. Input SGST account. 2. Input CGST account. In the first entry, we have credited output SGST and CGST. Why have we credited? It is a liability. We have collected it on behalf of the government and we have to pay. I am paying it now, so I will debit it. Here, we have paid, so we have the right to recover that money from the government. So it is our asset. So I have debited it. I will credit this now. I am taking the benefit of this. 400, 400. There is difference. Here debit 1000. Here credit 800. Difference is 200. What will this be? Yeah, bank account or cash. That's it. Did you all get this? This concept of adjusting this input with output is there, no? That is called as input tax credit. What is it called as? What we did now, no, set off that 500, 400. That you learn in GST in Inter. Not even in the first 2-3 days. You learn it towards the end. That adjustment. But sad and unfortunate, they have given it at foundation level only. No problem, we will do. They have given it to us to do. So what will we do? We will do. We can't complain. GST, not even in the initial days you learn. You learn it later in GST. But did you understand this? What you need to remember is, in the trial balance, they will give this output SGST as credit item. And in the same trial balance, they will give this input CGST as debit item. So we'll adjust them and then pay. Adjust them and then pay. There's one more thing that will be there. That is called as, I'll tell, IGST. That is for interstate transactions. How to deal with that? I'll teach that to you tomorrow. Where is it there? It's there in final accounts. When you do final accounts topic tomorrow, I will teach. I'll also show you that RTP question on this. See, in your RTP, there is one question. Based on this output GST, there is one journal entry. So I'll tell you the question. Question 3A in your RTP has GST adjustment. So please do that question today and come. Okay. On 8th April, there is some sale regarding which there is one GST transaction. And again on 10th April, there is one transaction. Again on that, there is GST adjustment. And on 19th April, there is one GST adjustment. So GST adjustment is there in that question. Please do that question before you come to tomorrow's class. Will you do that? RTP. And I've taught this to you. This concept, what I just taught, is more than sufficient for you to understand this portion. So this, if you want, I can share one small screenshot or small PDF of this topic to you people. Whatever I just discussed on GST. This. Yeah, or you can watch the video. It is around 1 hour 58 minutes in the video length. Or note the time, 6 o'clock. If you have doubt, around 6 o'clock, 6:10, we have discussed this concept. So please brush this concept. And in RTP, you do 2 topics. One on journal and other one is on final accounts. Final accounts part I will do in the class tomorrow when I do final accounts question. If I forget, you remind me. Understood this? Yes or no? Very good. Can we now go to the topic of rectification of errors? Shall we? Very good. You want me to send this at the end of the class today? I'll put it in one separate sheet. I'll share it. I'll share this file with you all later at the end of the day. Soft copy. Don't worry. I put everything that I should share it to you people in one page. I'll share it once for all in PDF format. Wherever you want it. Sir, I want hard copy. Hard to give. Can't give. Can we do rectification of errors now? Shall we? We'll do a quick revision of entire rectification and then we'll understand what complications can be there. I'll tell you a couple of things where people usually get wrong with regard to rectification. Okay. All good? People watching it on YouTube, is everything fine? Audio, video, give me a small confirmation if you can hear everything clearly. Speed. Space. Speed ಜಾಸ್ತಿ ಆಯ್ತಾ? Base ಜಾಸ್ತಿ ಇದೆಯಾ? ಎಲ್ಲಿ? Mic ಅಲ್ಲ. Mic I can't change. It's a big controller. I can only do this. Okay na? ಕೇಳಿಸ್ತಾನೆ ಇಲ್ವಾ? Now, CSK, not in my control. There are too many things for me to adjust. I'll get it checked. Don't worry. Errors. Errors are common. Errors do happen. Errors are not intentional. Only thing that we can do is not crib about those errors, but try to correct those errors. When we correct the errors, we'll get the correct financial results. If we don't correct the errors, because of errors, our financial results will be incorrect. Based on that, the decision that we take will also be incorrect. Got it? So the errors, which are unintentional mistakes, can be classified into 2: non-clerical and clerical. Non-clerical means what? It doesn't matter whether it is computerized or manual accounting. These errors will still happen. These are called as principal errors. What are these called as? Not principal. It is principal errors. What do you mean by principal errors? You have not followed accounting principle correctly. You have not followed accounting principle correctly. You recorded a capital transaction as revenue, or you recorded a revenue transaction as capital. You purchased asset, you wrote it in purchase book, or you purchased goods, you wrote it to asset. You got repairs done for furniture, you should debit repair account, you debited furniture account. So these are what errors? Principal errors. And when you do these principal errors, no, your balance sheet will still tally. Your trial balance will still tally. But these are continuing to be errors. These are two-sided errors. This is where you treated a capital item as revenue item or a revenue item as capital item. Example, read the example. Asset purchased wrongly recorded in, or repair expense debited to asset account. Do you get it? Then we'll go to clerical errors. Clerical errors can be error of omission, error of commission, or compensating error. To start with error of omission. Omission means what? Not doing what is supposed to be done. Not writing the entry what you're supposed to write. Further classification of these errors of omission can be made into complete omission and partial omission. What do you mean by complete omission? We have not written debit, we have not written credit, full transaction, palak paneer, whack. You have not written the complete transaction. What is it? Error of complete omission. Transaction is not recorded in journal, not posted to ledger, not written in trial balance, nowhere. There is no trace of that ledger only. You get it? That is complete omission. Doesn't matter what transaction is it. You have not recorded any part of the transaction. Because of this, trial balance will not tally ಅನ್ನೋ situation ಬರೋದಿಲ್ಲ. Trial balance will tally in spite of this complete omission. Why? You have not written debit, not written credit. Not written debit, not written credit. Trial balance will still tally. However, what do you mean by error of partial omission? Partial omission is where transaction is recorded but not completely. We recorded debit aspect of transaction but didn't record the credit aspect. Or we recorded the credit aspect but we didn't write the debit aspect. We recorded the entry in purchase book, we didn't write it in creditors book. We wrote it in creditors book but we didn't write it in purchase account. We wrote the entry in sales book, forgot to post it to debtors account. One side correct, one more side wrong. You get it? That is error of partial omission. Because of this, trial balance will disagree. Trial balance will not tally if there is errors of partial omission. Then we have error of commission. What is error of commission? You have recorded the transaction. Have you recorded the transaction? Yes. Have you recorded at correct amount? No. You have recorded the transaction at wrong amount. At wrong amount. Or amount is correct, account is wrong. Amount is correct, account is wrong. So when you record a transaction either in the wrong account or at the wrong amount or it is wrongly balanced, that is what we call as error of commission. What is it? Transaction entered at wrong amount or in wrong account or wrongly balanced. Clear? Goods purchased from Dolu. We wrote it wrongly in Bolu account. Purchase is 4,500. You recorded it 5,400. This is error of commission. Lastly, we have compensating error. What is compensating error? It is not one error. It is two errors. How many errors? When you do two errors, no. First error will eat away the impact of the second error or it has nullified the impact of second error. Because of which now there are two errors. But we won't even identify. Why? The amounts are also wrong. When cash is received, we should debit cash. We wrongly credited cash. When cash is paid, we should credit cash. You thought when I received cash, I credited it. So when I pay cash, I should debit it. Now you will debit. Now we did two errors. Let us say first error is 100 rupees. Second error is 90 rupees. Difference will be 10. We won't be able to find. We will be searching 190, but the error is 10. You get what? We will be searching 10, but the error is in 190. So it is actually very difficult to find compensating errors because one error has nullified the impact of another error to an extent. So what is compensating error? Like I mentioned, one error has cancelled out or reduced the impact of another error. And again, this is not a self-revealing error. Trial balance will tally in spite of this error. Even after doing compensating, our trial balance will still tally. We won't be able to find any mistakes. So that's compensating error. Did you all understand compensating error? Very good. Now, like I just mentioned, impact of errors on trial balance, one-sided and two-sided. If it is one-sided error, because of this, our trial balance will not tally. Our trial balance will not tally. If there is a two-sided error on the other hand, in spite of this, our trial balance will tally. I'll tell the error. You tell me whether it is one-sided or two-sided. I already told it to you. Shall we start? Principal error. One-sided, two-sided? Two-sided. In spite of principal error, trial balance will still tally. Come on, you have one more chance. Error of complete omission. two-sided. Error of partial omission, one-sided. Error of commission can be one-sided, can be two-sided. We don't know. See, when they do that mistake, no, error of commission, they can do on one side or they can do on both sides. So that can be either ways. What about compensating error? Usually two-sided error. So what are one-sided errors? Error of partial omission, and it can be commission error. However, what are two-sided errors? Principal errors, complete omission, commission, and compensating error. Did you all get it? Akka? Fantastic. So what I want you to know after this is, in order to rectify the error, we need to identify the error. Let me repeat. In order to rectify the error, we need to identify the error. At what stage have we identified the error is the decisive factor for rectification. If we identify the error at initial stage, we'll scratch and rewrite. This is time pass. We don't have stage 0. If we identify the error before preparation of trial balance, then we should check whether that error is one-sided error or two-sided error. If it is one-sided error, we only do adjustment. We cannot pass journal entry. However, if that error identified before trial balance is two-sided error, then we can surely pass journal entry. Then we'll check whether if the error is identified after trial balance. Then what happens? When I prepare trial balance will not tally. Am I right? When I prepare trial balance and there is an error, trial balance will not tally. Whenever trial balance doesn't tally, I would have written that money in suspense. When I kept the money in suspense, then for one-sided error also, I will pass journal entry with suspense account. However, if it is two-sided, anyways we pass journal entry. We won't even need suspense account. Let's take an example. For example, you left your water bottle in the class and then you left. Before I close the classroom, I saw it. I will give it to you. Adjustment. We both only will deal with it. However, you didn't come back to take the water bottle. Classroom is about to be closed. Office boy will take the water bottle and then keep it in the office. You have to go collect your water bottle from the office. This is trial balance. Before the trial balance is closed, if you identify your error, I will rectify, we will adjust it. There is no need of journal entry. You get it? You don't have to show your ID card. You don't have to say that this bottle belongs to you. You don't have to show the picture of water bottle. I'll take the water bottle and go. Adjustment. Am I right? However, if the trial balance is already closed, water bottle would have gone to office. Then they'll say, what is the proof that that bottle belongs to you? You have to show them your ID card saying that you are the student here. You should prove that the bottle is yours, then take it. So basically their journal entry is required. Just a random example which spotted just now. Don't look at me like that and judge. So if the error is before trial balance, one-sided adjustment, two-sided journal entry. If the error is after trial balance, one-sided journal entry with suspense, two-sided journal entry. If it is after final accounts, again we do the same thing. One-sided means journal entry with suspense, two-sided is journal entry without suspense. Sir, stage 2, stage 3 look same. Are they same? They are same but different. What is the difference there? If in case we are doing rectification at stage 2, no, after trial balance, no problem. Seek the account, whichever account you want, you can debit credit. However, if you are doing rectification at stage 3, that is after final accounts, you know what should you keep in mind? If the error rectification involves a nominal account, if the error rectification involves a nominal account, such a nominal account cannot be debited or credited. You cannot debit or credit such nominal account. Why? Very simple. If you debit or credit that nominal account, that will not affect previous year. That will affect current year. It is like yesterday you forgot to put sugar to your coffee. Today will you put 2 spoons extra? No. Sakare coffee pudi aktang agate. You get it? It won't be nice. Yesterday's coffee anyway got spoiled. Today's coffee also will get spoiled. So last year purchases was recorded incorrectly. Are you getting it? This year you realized it. If you rectify by using purchase account, current year purchase will become wrong, current year GP will become wrong, current year NP will become wrong. So at stage 3 rectification, after final accounts, when you are rectifying, if you find an item which is nominally in nature, what in nature? Then what do? You cannot use such nominal account. You will replace that nominal account with what? profit and loss adjustment account. What will you replace it with? Profit and loss adjustment account. Did you all get this? Pakka? Very good. So by this we are done with how to do rectification and how to pass all of these rectification entries. Steps to pass a rectification entry. First, identify the wrong entry, then reverse the wrong entry, then think of the correct entry. Rectification entry will be reversal of the wrong entry plus the correct entry. Reversal of the wrong entry plus the correct entry. That will be the rectification entry that we should pass. You got it? Overview of rectification of errors is done. If you are interested, I'll take our RTP question and then show that to you with the help of the RTP question. Is that fine? Shall we see our recent attempt RTP? Come on. ICI.org. We are going to students. I am opening BOS knowledge portal. In our BOS knowledge portal, let us go to previous year question papers. Allah, yours is the first attempt under new scheme, revision test paper, and then I'll go to foundation accounting. Rectification of errors question. Shall we see this rectification of errors question? Beta Chemical Labs are unable to agree the trial balance as on 31st March. So what has happened? It is not stage 1. It is not before trial balance. Trial balance is done. Sir, is it stage 2? It can be stage 3 also. How will we get to know if it is stage 3? If they tell that these errors are identified in the next year, it will become stage 3. If they don't tell that the errors are identified in next year, if they say errors are identified before preparation of final accounts, it is stage 2. What is the difference between stage 2 and stage 3? Stage 2, I will continue to use nominal accounts. Stage 3, I'll replace nominal accounts with P&L adjustment account. Am I right? Come on, let us see this. And I've raised a suspense account for the difference. Very good. They've done this correctly. If they would have not done this correctly, if they would have not raised the difference and written into suspense, some questions they will tell in the question, it's there in our study material also. The trial balance did not tally, the difference was posted to P&L account. When the trial balance doesn't tally, where should you write the difference? Suspense. If they wrongly write it to P&L, you know what will happen? Whenever we write rectification entry, usually wherever you use suspense, no, their suspense will get cleared. I'll tell you once again, listen. Trial balance doesn't tally. There is difference. You write it to suspense. When you pass rectification entry, every time you debit suspense or credit suspense, suspense balance is getting cleared. Suspense balance is getting cleared. If you have created suspense in trial balance, when you pass rectification, suspense will get cleared. If you don't create suspense, you transfer the difference to P&L. Every time you pass rectification entry, you are creating suspense. Are you getting it? Cash account debit to sales is the entry that we should write. We didn't write cash account debit. We wrote only to sales account. Trial balance won't tally. Am I right? Cash debit is not written. So we'll write suspense debit 10,000 in trial balance. Am I right? Say something. When you pass rectification entry, you will write cash account debit to suspense. Cash account was supposed to be debited, not debited. We will debit cash account now and credit suspense. Am I right? Yes or no? When you write cash account debit to suspense, suspense 10,000 credit will clear the suspense debit in trial balance. This is because you created suspense. What if by mistake they had written that difference to P&L? Our profit is wrong. Our profit is wrong because of that error. That profit has gone to capital. Now this year when we identify the error, wherever we use suspense, no? That suspense should be closed by transfer to capital. That suspense should be closed by transfer to, I'll repeat the entire thing what I just told to you now. Whenever trial balance doesn't tally, where should we write it? If they have written suspense, very good, no problem, all fantastic. What if they have not written the balance to suspense and instead they have written the balance to P&L? Then we'll close our suspense account and transfer the balance to capital. Usually do we close our suspense ledgers? Suspense, we'll write journal entry, leave it like that. If in the question they have told that difference in trial balance is closed by transfer to P&L, Suspense account also will be closed by transfer to P&L at the end. There is a question on this in your study material. Please go through that question once. If you don't recall this, you remind me tomorrow. I'll show you that question as to what it is. Okay. Come on. Beta Chemical Labs were unable to agree the trial balance and they have transferred it to suspense. Very good. They have done a good job. Next year, the following errors were discovered. When is the errors discovered? So this is stage 3 rectification. This is stage 3 rectifications. Errors are identified after final accounts. Can we see the errors? First one. Repairs made during the year were wrongly debited to building. Principal error. They should have debited which account? Repairs. Because the expenditure is incurred for repairs, they should have debited repairs. Have they debited repairs? What have they debited? Building. They should have debited repairs. What have they debited? Building. So building is wrongly debited. We should have not debited buildings, but we have debited buildings. So building account which was wrongly debited will be now credited. Building account which was wrongly debited will be now credited. Error. Commission error. Using the wrong account. Okay. So we have wrongly debited building. So I will credit building. I should have debited repairs. Have I debited repairs? So what will be the rectification entry? Repairs which was supposed to be debited was not debited. So I will debit repairs. Building what was supposed to be not debited was debited. So I will credit building. Journal entry will be repairs account debit to. Very good. Repairs account debit to. This should have been the entry at stage 2. Because this is stage 3, I cannot use repairs account. Repairs will be replaced with P&L. Entry will be P&L adjustment account debit to. I will show the answer to you. See here. Repairs account debit to building will be entry. Because this is after final accounts, I will replace repairs with P&L adjustment account 12,500. Everyone got it? What is after this? Read the next one. Addition of freight column in purchase journal was short by 15,000. When you total the freight column, you total less by 15,000. You totaled 1 lakh. The total should have been 1 lakh. You wrote 85. You have decreased the total by how much? 15. If you have decreased the total by 15, write when you write journal entry, you written less by 15. So what should you do? Write the entry for that 15. Freight is expense or income? Freight is expense. Expense. We should debit it. Freight account debit to suspense. Don't write cash. It is paid correctly. Cash account correct agide. Freight total is shortage. So freight of 10,000, freight of 15,000 which was supposed to be debited is not debited. So now I will debit freight account debit 15,000 to suspense account 15,000. Entry is freight account debit to suspense. But this is rectification at stage 3. I cannot debit freight. I will replace freight with P&L adjustment. Entry will be freight to suspense, which will be now replaced to P&L adjustment to suspense. Got it, everyone? Say something. Very nice. Goods to the value 4,500 returned by a customer. Shiv one company. So this is actually sales return. I have sold the goods for 4,500 and my customer is returning the goods back to me. What is this? Sales return. Don't read the rest of the question. Read the question in pieces. Tell me what is the journal entry for sales return. Sales return account debit to Shiv one company. I should have written the entry sales return account debit to Shiv one company. But whatever return had been posted to the debit of Shiv one company. You should write sales return account debit to Shiv. Shiv should be credited. I have debited. Now I should credit Shiv by double the amount. Why? I should have not debited. I have debited. To reverse the debit, I will credit once. I should credit it. I have not credited. No, I will credit it once again. I should credit it with double the amount. For example, Mr. Shiv is there. No, I am supposed to give him 4,500. I am supposed to give him. Why? He gave the goods back to me. He purchased the goods from me. He gave the goods back to me. I should give him 4,500 back. No, I say I don't have cash. He returned the goods to me. I told give me 4,500. He's like, why should I get it? Give, I'll tell you. And I took 4,500 from him. No, I should give him how much? Why? I should return this 4,500 what I have collected. And I should also give 4,500 what I am supposed to give. I cannot say no. 4,500 I'll give. Take. He'll be like, okay, okay. Where is 4,500? I gave no. Hey, but I returned the goods. That only I am giving money. No, I gave 4,500. See, what 4,500 you gave, I returned, and I gave you 4,500 for goods returned also. Hey, ಒಂದೇ 4,500 ಇದೆ ಅಂತ ಹೇಳಿದ್ರೆ ಒಂದೇ ಇದೆ ಅಲ್ವಾ, ಇನ್ನೊಂದು 4,500 ಕೊಡ್ಬೇಕಲ್ವಾ? ಆರ್ ಯು ಅಂಡರ್ಸ್ಟ್ಯಾಂಡಿಂಗ್ ದ ಫ್ರಸ್ಟ್ರೇಷನ್ ಆಫ್ ಶಿವ್ ಹಿಯರ್? Journal entry is sales return account debit to Shiv and company. We should have credited Shiv and company. We have not credited. We will credit now. We had wrongly debited. That debit reversal also will credit. So to Shiv and company 9,000. How much? 4,500 plus 4,500, 9,000. Everyone understood? Next, and also sales return. Also sales return andre sales return is also debited. Shiv and company is also debited. What is the correct entry? Sales return account debit to Shiv and company. What have we written? Sales return account debit, Shiv and company account debit. So meaning sales return was supposed to be debited. Sales return is correctly debited. There is no error in sales return. Shiv and company should not have been debited. It is wrongly debited. So I will now credit it. Pakka? Say something. That's it. Journal entry is suspense account debit to Shiv and company, but 9,000. How much is the amount? Everyone got it? Say something. Fantastic. Third one is over. Then come, let's go to fourth one. Sundry items of furniture sold for rupees 30,000. What price did we sell it for? 30,000. Had been entered in sales book. Oh, it is furniture sold. What did we sell? Furniture. Furniture asset. Where have we written? Sales book. When we sell furniture, it should be written in furniture account. Entry should be cash account debit to furniture. They have written cash account debit to sales account. It has been posted in sales account. So what is the correct entry? Cash to furniture. What is the entry written? Cash to sales. Furniture should have been credited. Sales is credited in that place. Sales which should not be credited is credited. So sales will be debited. Furniture which should be credited is not credited. Credit now. Journal entry. Sales account debit to. Very good. Sales account debit to sales account debit to furniture. But this is rectification after final accounts. So I cannot debit sales. In the place of sales, I'll replace it with profit and loss adjustment. In the place of sales, I'll replace it with profit and loss adjustment account. Did everyone get it? Very nice. After fourth one, come to fifth one. A bill of exchange received from Messer Swapna. No, not Swapna. Sapna. For rupees 75,000 has been returned by bank as dishonored. Oh my God. I have received one bill of exchange from Sapna. For that journal entry, bills receivable account debit to Sapna. I discounted it with banker. Journal entry, bank account debit, discount account debit to bills receivable. Bank will give me money, bank account debit. Bank will cut discount. My expense, discount account debit. Bill is going out, to bills receivable credit. Journal entry, bank account debit, discount account debit to bills receivable. Done. This bill is dishonored. Means what? Bank went to Sapna. Sapna told, oh, well, hey, I won't give money. So now bank came back to me, asking me for money. Why? Bank doesn't know Sapna. I gave the bill to bank and asked bank to collect money from Sapna. Now Sapna doesn't pay, bank will come to me. When the bank comes to me, bank will throw the bill on my face. Then I should pay full money. Correct or not? When the bank gives the bill back to me, what is the entry that I should write? Bills receivable account debit, because the bank is giving me bill. Full money to bank. Bills receivable account debit to bank. How much? Full 75,000. Will I keep this bill with me? Then what do I say? I will give it to Sapna and collect money from Sapna. Am I right? So first, when the bill is received, what is the entry? Small revision of bills of exchange is also happening here only. What is the entry when I receive the bill? Bills receivable account debit to Sapna. Bill is received from Sapna. What is the entry? Bills receivable account debit to Sapna. I give it to bank and discount it. Bank account debit, discount received account, discounting charges account debit to bills receivable. Done. I have received the money. Now what will I do with this? What will banker do? Go to Sapna. If Sapna doesn't pay money, banker will give the bill back to me and I will give the money to bank. When I give money to bank, what is the entry? Bills receivable account debit to bank. After banker gives the bill back to me, I should give the bill back to Sapna. When I give the bill back to Sapna, what is the entry that I should pass? Sapna account debit to bills receivable. Got it? They have done everything. They didn't write this entry to Sapna. See this? Bill of exchange received from Sapna for rupees 75,000 had been entered by the bank as dishonored and had been credited to bank and debited to bills receivable. So meaning bank atra bill is kondu, giving money to bank, entry they have written, giving it to Sapna, entry they have not written. What is the entry that you should write? Sapna account debit to, that's it. Sapna account debit to bills receivable. That's it. Should we replace bills receivable or Sapna with P&L adjustment? No. They are not nominal accounts. It will remain like that only. Understood this? Everyone. One last point that I want you to remember is whenever you do this rectification after final accounts, we write no new account here. P&L adjustment, P&L adjustment, P&L adjustment. We should total the P&L adjustment and post it to capital. How do we do it? Take all the debits at one place, credits at one place. Debit 12,500. Debit 15,000. So debit 27,500. Debits ಎಲ್ಲ add ಮಾಡಿ, credits ಎಲ್ಲ minus ಮಾಡಿ. Debit 12,500 plus debit 15,000. Will become debit 27,500. Here there is no debit credit. Here there is debit of 30,000. Add further 30,000. 57,500. Here we don't have anything. So how much is the total? 57,000 debit no in your calculator. You should close that balance. How do we close it? You should do minus 57. Debit plus credit minus. So I will credit P&L adjustment account 57,000 and debit capital. So what is the entry? Capital account debit to profit and loss adjustment account 57,500. 57,500. This is the entry. Did you understand this? Couple of adjustments will become little tricky when they use certain words like general ledger and then general ledger, sales ledger and then purchase ledger. This is one tricky name that they use. This is one thing what usually students ask a lot of doubts. I am telling other than this question. So remember, whenever they say there is a sale transaction correctly entered in sales ledger but not entered in general ledger. What do they mean? When they say sales ledger, it means debtors account. When they say purchase ledger, it means creditors account. I am not talking about debtors, sales account, sales ledger. They use the word sales ledger, purchase ledger, general ledger. These three are the concepts of self-balancing ledgers, which is a chapter which was there in CA IPCC long ago, and that got removed when now syllabus you're reading, no? Before that there was one syllabus was there, no? Before that one syllabus was there. Adralittu, self-balancing ledger. Under manual system of accounting that is there. So that topic is removed. Very nice topic. I used to love teaching that topic, but it's removed now. In a manual accounting, that's a savior, but now not required. So it's called as self-balancing ledgers. What is it called? Sales ledger, purchase ledger, general ledger. Sales ledger means debtors account. Purchase ledger means creditors account. General ledger is anything other than debtors and creditors. Bad debts is been correctly recorded in sales ledger but not posted to general ledger. I'll repeat. Bad debts has been correctly recorded in sales ledger but not posted to general ledger. What does that mean? What is the journal entry for bad debts? Bad debts account debit to debtors. Bad debts account debit to, bad debt is general ledger. Debtors account is sales ledger. It's been correctly written in sales ledger, not posted to general ledger means they have not written bad debts account debit, should debit bad debts account. Understood this? And sometimes second kind of tricky question that will come is they'll tell sales of rupees 10,000, sales of rupees 10,000 what not was correctly recorded in the sales book but not posted to ledger. I'll repeat, sales of rupees 10,000 was correctly recorded in sales book but not posted to ledger. Not posted to ledger means is it sales account or is it debtors account? Debtors account. Why? Sales account will include only total of sales book. I'll tell you the same statement in two ways. In one place the error is in sales book, in sales account, in one place there is in debtors account. I'll tell. Credit sales of 10,000 was entered in sales book. Credit sales of rupees 10,000 was entered in sales book but was not posted to the ledger. The error is in sales account. Why? To the ledger. Sales book total will go to sales account. Individual transactions in sales book will go to debtors account. Let me repeat. Total of sales book will go to sales account. Individual transactions will go to debtors account. When they say the means it is sales account. When they just say to ledger, it is debtors account. And if they use the word total, sales entry was correctly recorded in sales book, but total was not posted. Total was incorrectly posted. Total will go to sales account. So the error is in sales account. If they talk about individual transaction, it is error in debtors account. This question is again there in our study material. So when you go through that, you will find this one error. So I'll tell you how to spot the error. If they tell entered in sales book but not posted to ledger, error, sales or debtors? Sales or, am I talking too fast? Error is, sorry, sales is correctly recorded in sales book but not posted to ledger. Debtors, not posted to the ledger. Sales is correctly recorded in sales book, total is incorrectly posted. Sales, total will go to sales account, total will not go to debtors account. Understood that part? Very good. So by this we are done with the concept of rectification of errors. Rest everything you guys try it by yourself. If in case you guys have any doubt, you can surely come back to me. And we have not just finished rectification of errors, we have also finished the topic of accounting process. Can we start with bank reconciliation statement? Short break, 1 minute only, and then we'll start with bills of bank reconciliation statement. Once we finish bank reconciliation statement, we'll take some 10 minutes break. ನೀವು ಕೆಳಗಡೆ ಕ್ಲಾಸ್ ರೂಮ್ ಕ್ಲೋಸ್ ಆಯ್ತು ಅಂತ ಬಂದ್ರಾ ಮತ್ತೆ ಏನಪ್ಪ ಇವಾಗ I'll come back. I'll fill my water bottle and come. Then other two fixed one.
One was with me, he was saying it.
He left.
He had headache, he had to go somewhere.
He had headache because of.
He has some psych.
He's psych.
No, like
I am psych. No, it's just worried. If someone just walks away in the break, what does that mean?
He had to go somewhere. He'll come.
He'll come? It is not like he is finding it too boring and then going. Yeah, it's okay. It's okay if the topic is boring. Why? This is not Shah Rukh Khan movie, There should be entertainment, commercial element, action, romance, script. However, in movies also that's not there nowadays. Movies also they don't try to spend money on script. They just throw money. Samar. Sorry, Samir. We'll do summer question after this. ಏನಾಯ್ತು? All good? ಏನಾಯ್ತಮ್ಮ? Okay. Can we do BRS? What happened? Everything fine? ಹೇಳ್ರಿ. You are telling something, but she's telling. Okay, guys, come on. Let's now do chapter 3, bank reconciliation statement. Let us start with the topic of bank reconciliation statement. To start with, the first and foremost question is, what is bank reconciliation statement? The answer is, it's a statement. What is it? It's a statement. If it is a statement, why do we prepare bank reconciliation statement? Here we'll give wrong answer. We will tell to find balance as per passbook, to find balance as per cash book, which is wrong answer. Why? The objective of preparation of BRS is not to find balance as per passbook. Balance as per passbook will be available in passbook. Balance as per cash book will be available in cash book. Between them, there will be no coordination. There is differences between balance as per cash book and balance as per passbook. Let me repeat. There is difference between balance as per cash book and balance as per passbook. They are not matching. Because they are not matching, we want to identify why are they not matching. What is it that is there in cash book but not there in passbook? Or what is it that is there in passbook but not there in cash book? Ninnalli irodenu nannalli illade irodenu. So you are trying to find the difference. Why? That difference can be because of error. That difference can be because of, why do you want to compare passbook with cash book? To check if there is any error. If there is any error, we should do rectification of errors. What should we do? Actually, 50% of this BRS chapter is extension of rectification of errors. In rectification, they give the error, we rectify. In BRS, we need to check if there is an error and then rectify. Sometimes we find some difference which is not error, that we won't rectify. That is the only reason why BRS is not given in rectification. And one mistake what we do BRS first topic, or we do BRS and then we do rectification at the end. We shouldn't do. Should first finish rectification of errors and only then start with BRS. Whenever you do BRS before rectification, you're doing a big mistake in your life. Sorry, you're doing a big mistake in accounts. Life ante. So first one, what is BRS? It's a statement. Why do we do BRS? To reconcile. What is the second word? To reconcile. What do you mean by the word reconcile? Reconcile is knowing the reason for difference. What is reconcile? Knowing the reason for. Very good. Whenever there is difference between cash book and passbook, we want to know why is there a difference between cash book and passbook, and we will rectify that mistake if there is one. So to reconcile means what? Knowing the reason for difference. Knowing the reason for. Now let's focus on the word difference. What do we mean by difference? What do we mean by difference? How can there be difference? The difference is between cash book and passbook. Okay. Difference is between cash book and passbook. Cash book is the record that we have kept. Passbook is the record that banker has kept. Let me repeat. Cash book is the record that we have kept. Passbook is the record that banker has kept. Between them, there might be some transactions which are there in cash book but are not there in passbook. Transactions which are there in passbook but they are not there in cash book. These errors have to be rectified. Okay, now let's see what is the reasons for difference. The first reason for difference. You have given a check to somebody. You have given a check to somebody. The moment you give them the check, you pass the journal entry, purchase account debit to bank account, or that party account debit to bank account. You pass the journal entry. The moment you pass that journal entry, your bank balance as per cash book will reduce because you pass the journal entry in cash book. Bank balance as per cash book will. However, this entry is not recorded in passbook yet. Why is it not recorded in passbook? After you give the check to that person should take that check to bank and deposit in bank. That's when the banker will clear that check. Banker has not yet deposited, the person to whom you have given the check has not yet deposited the check with banker. or he has deposited it with banker, banker has not collected the money from my banker, banker has not cleared it, so passbook balance will not reduce. I repeat, we have issued the check and we wrote the entry in cash book, it reduced. This check is not deposited with banker or this check is not cleared by banker, so passbook balance is not decreased. Cash book has been decreased, passbook has been not. This is the reason for difference. What is the first reason for difference? Check issued but not deposited, or check issued but not cleared. If this is the reason for difference, if your starting point is balance as per cash book, you should add. If your starting point is balance as per passbook, you should deduct. What if the starting point is overdraft balance? Ulta? No, don't do ulta. Balance as per cash book is overdraft of 10,000, right? Balance as per cash book minus 10,000. Don't change all the add items to less, all the less items to add because the opening balance is overdraft. Add items, let it be add. Less items, let it be less. Opening balance is overdraft, that balance will become minus. One item should not shake the entire table, only that item you change. Are you getting it? So if you're still doing that approach of all the add items making it less, all the less items making it add because the balance is overdraft, don't do it. Are you getting it? So check is been check is been issued, so balance as per cash book has reduced. It is not cleared, balance as per passbook has not reduced. If you're making changes in cash book, we will add. If you're making changes in passbook, we will deduct. That's it. If it is overdraft, write the opening balance as negative. Shall we go to next reason for difference? And this difference is timing difference. I'll tell you what is timing, non-timing later. Second one, check is received but not deposited, or check is received and deposited but not cleared. You received a check from some customer. When you received it, immediately you wrote bank account debit. Your bank balance as per cash book has increased. But you have deposited that check with the banker, or you have not deposited the check with the banker, passbook balance has not increased. Even if you deposit, banker has not cleared, so the passbook balance has not increased. Is there a difference? Yes, there is a difference. So what should you do in this case? If you're starting with balance as per cash book, if your starting point is balance as per cash book, what should you do? Minus. If your starting point is balance as per passbook, add. Understood? Say something. Very good. Then direct deposit by customer into bank account. What do you mean by direct deposit by customer? Your customer went to bank and deposited the check or money in your name and came back. When your customer deposited money in your bank account, your bank balance as per passbook has increased. Your bank balance as per passbook has, but your bank balance as per cash book has not increased. Bank balance as per passbook has increased, bank balance as per cash book has not increased. Is there a difference? Yes. If your starting point is balance as per cash book, what should you do? Add. If your starting point is balance as per passbook, what should you do? That's it. Understood? Then you have asked the banker to make payments on your behalf without asking you. You have given standing instructions to the banker to make payments. You have given standing instructions to the banker to make payments. When the banker makes standing instructions on your behalf, balance as per passbook will decrease every time the banker make payment. You have not written it in cash book. Banker has paid, passbook has decreased, cash book no entry, cash book has not decreased. Are they in the same line? Is there a difference? Yes. Where are we making changes? If we are making changes in cash book, what do I do? Minus. If you are making changes in passbook, what do I do? Add. Did you get it? Very good. What about the next one? Receipts collected by the banker on our behalf. Without informing us, banker has collected money on our behalf. Interest, dividend, all of this. When the banker has collected money on our behalf, balance as per passbook has increased. Balance as per passbook has, balance as per cash book has not increased. Balance as per cash book has not increased. Passbook balance has increased, cash book balance has not increased. Where are we making changes? If you're making changes in cash book, you add. If you're making changes in passbook, you deduct. Understood? Then comes to the sixth one. Sixth one is where bank charges have been recorded by the banker, but we have not recorded it. Or bank charges is recorded in passbook only. If the banker has recorded bank charges, bank balance as per passbook would reduce. Entry is not made in cash book is not changed. Where are we making changes? If you're making changes in cash book, we reduce. If you're making changes in passbook, we add. Everyone got it? What if bank interest is collected by banker on our behalf? If the interest is collected by banker on our behalf, bank balance as per passbook would have increased. Cash book, there is no entry. If you're making changes in cash book, I should add. If you're making changes in passbook, I should deduct. Then next one, what if the error has happened in passbook or error has happened in cash book? We should see what is the error. Someone else has given check to somebody else. Someone else, not you. Someone else has given check to somebody else. Banker by mistake reduced your passbook balance. Because of that, passbook balance is reduced. Cash book is not. Making changes in cash book, minus. Making changes in passbook, add. Understood? What if by mistake banker has increased your passbook balance? Someone deposited check into their account. Banker should give credit to them. No, banker wrongly gave credit to you. Because banker gave wrongly credit to you, your passbook balance has gone up. Your cash book balance is not. Where are we making changes? If you're making changes in cash book, what should I do? If you're making changes in passbook, what should I do? Understood? Say something. What if you have by mistake written a transaction in cash book at a higher amount? You are supposed to receive 1 lakh rupees from some customer. How much are you supposed to receive? You gave him 5,000 rupees discount. So how much will he give? 95,000. How much will he give? You tell me. In my cash book, in the bank column, I should write 95. In discount column, I should write 5,000. Am I right? There is an adjustment where erroneously the transaction was recorded in the bank column at gross amount. Gross amount is 1 lakh. Discount is 5,000. Net amount is 95,000. Gross amount is 1 lakh. Net amount is 95. Discount is 5. How much did you receive? 95. How much discount did you give? 5. Correct? In bank column, should you write 95 or 1 lakh? 95. We by mistake wrote 1 lakh. What happened? Balance as per cash book has increased. Passbook, how much will it go up by? 95. Passbook goes up by 95. Cash book has gone up by 1 lakh. Is there a difference of 5,000? Yes. If you're making changes in cash book, minus. If you're making changes in passbook, add. Understood this? That's it. These are the differences what we're trying to deal. Am I right? When are we doing all of this? In bank balance as per cash book and bank balance as per passbook comparison. When is BRS prepared? Some of them say weekly, monthly, quarterly, half yearly, yearly. When should we prepare? Whenever we want to prepare, we can prepare. Someday in the night at 12 o'clock, you're not getting sleep, you want to do BRS, you can do BRS. No one is stopping you. But mandatorily, you should do BRS before you do final accounts. Mandatorily, you should do BRS before you do final accounts. Why? Once you do final accounts, your bank balance is posted to balance sheet. What if that bank balance in the balance sheet is wrong? If that bank balance in the balance sheet is wrong, tappalva. So when you're preparing balance sheet, when your trial balance is done and you're about to prepare balance sheet, just check once whether you are what is correct. Bank balance is correct. How do we do it? We prepare BRS. So you can do it at regular intervals based on management discretion, but it is mandatory that you must prepare it on balance sheet date. Do you get this? Now, which balance to show in balance sheet? Should we show balance as per cash book or should we show balance as per passbook? We should show balance as per amended cash book. We should show balance as per, what do you mean by balance as per amended cash book? This balance as per cash book is there. No, that is or that can be wrong. When we check cash book and passbook, we identified those differences. Those differences can be timing difference or can be non-timing difference. Among those differences, if there is any non-timing difference, that is basically error. We need to rectify the error. I told you what is the objective of preparation of BRS is to identify the error and rectify it. Whenever there is difference between these two, that should be timing difference. What difference? What do you mean by timing difference? Check is been issued, cash book it is reduced. Check is been not cleared, passbook is not reduced. By another day or two, passbook balance will reduce. You don't have to do anything from your end. When the check is issued, entry in cash book. When the check is cleared, passbook will entry. Right now the check is issued but not cleared. The difference is time. Today check is issued, 3 days or 4 days later check will get cleared. During those 4 days, you don't have to do 100 squats or you don't have to do pray to the God for the check to get cleared. It will get cleared. It will get cleared by itself. Am I right? That is timing difference. Cash book it's come today, passbook it will come in 3 days or 4 days. What is that? Timing difference. What about check deposited but not cleared? Timing difference. Why? When you deposit the check, cash balance has increased. It will get cleared when the check will get cleared. Passbook will increase eventually. You don't have to do anything. But bank charges, interest or direct deposit by customer, these transactions have been recorded in passbook. You have not recorded in cash book. Until and unless you record it in your cash book, difference will always be there. Difference will never go away. So you have to make the entry. That is clearly error of omission. Bank charges recorded in passbook only. Interest credited in passbook only. Direct deposit by customer recorded in passbook only. What are all of this? What are all of this? These are errors. Complete omissions. We should record in cash book. If we have not recorded in cash book, it is our mistake. If we have not recorded in our cash book, it is completely our mistake. We have to record it. We haven't recorded it. We will record it now. We have to record it. We haven't recorded it. We will record it now. Did you all get it? Say something. Very good. So now we'll take some help in identifying timing and non-timing differences. What is timing, non-timing difference? Difference between passbook and cash book other than the reason of time. Time andre enu. By some time it will get cleared. You give some time and the difference will no longer be there. Okay. Now, check is issued but not deposited, or check is issued, deposited but not cleared. Timing, non-timing. Timing difference. You give little time and it will get cleared. What about check deposited but not cleared? Check received but not deposited, or check received and deposited but not cleared? Timing. How about direct deposit by customer into bank account? Non-timing difference. How about payments made by the banker on behalf of the account holder, not recorded in cash book? Non-timing difference. How about receipts collected by the banker on behalf, not recorded in cash book? Non-timing difference. How about bank charges recorded in passbook only? Non-timing difference. How about interest recorded in passbook only? Non-timing difference. How about errors in cash book? Non-timing. How about errors in passbook? Thank you. Now, if it is error in cash book, it will get rectified only when we do it. If it is error in passbook, we have to rectify. We don't have to rectify. Banker will rectify. We just have to wait. All of these which are red flags, no, non-timing differences, they will come in amended cash book. Where will they come? However, if it is green color flag, it will continue to appear in BRS only. It will continue to appear in. Did you all understand? Remember, all the non-timing differences are errors, needs to be rectified in amended cash book. Timing differences will continue to arise in BRS only. If you prepare BRS, without doing amended cash book, timing, non-timing, everything will come in BRS. If you do amended cash book, from all the differences, timing differences will continue to be there in BRS, non-timing differences will go to amended cash book. Let me repeat, in your BRS, timing, non-timing, all the errors, all the differences will be there. After BRS, if you prepare amended cash book, everyone, I don't want to tell again and again, everyone, either here or out, or if you are here, you should be quiet. Entire row. Okay, please don't make me tell once again. So, what was I telling? All the differences from BRS will be it will be there in BRS. When we prepare amended cash book, what do we write in amended cash book? Only non-timing differences. If you prepare BRS after amended cash book, what will come in BRS after amended cash book? Only timing differences. Only. Did you everyone understand this? Sir, in amended cash book, what to write on debit side, what to write on credit side? Very simple. If it is a plus item, write debit. If it is a minus item, write credit. Plus item in BRS will appear in debit side in amended cash book. Minus item in BRS will come in credit side in BRS. Here you will ask one beautiful doubt. Sir, some items are plus sometimes if you start with cash book. The same item is minus if you start with passbook. What to do? Remember, the appropriate way of doing cash book, BRS is always starting with cash book. You will never start with passbook balance. You should always, remember this, you should always start with balance as per cash book, never with balance as per passbook. Sir, but in material there are a lot of questions where we start with passbook. That is because we don't have balance as per cash book. If we have balance as per cash book, we should always start with balance as per cash book. Only and only if we don't have balance as per cash book only in the question. They give us balance as per passbook. Then we'll start with balance as per passbook. If you start with balance as per passbook and arrive at cash book, you can't do amended cash book like that. Then you should do one more BRS CB to PB and then do your amended cash book. Are you getting it? And do amended cash book in the exam only and only if it is asked. Only and only if it is asked. When they ask, they'll tell very clearly. Tell me, compute the amount to be shown in balance sheet. They'll ask. Or prepare amended cash book. Buy bitu keltare. If they ask, do amended cash book and BRS after amended cash book. Okay, say something. By this we are done with BRS topic. Let's quickly see that one question that is there in the material on BRS. Sorry, one question that is there in our RTP. Can we? Okay guys, come on. RTP question. Summer and Company. Please read. On 31st of December 2023. Showing a. Okay, favorable balance is positive balance. If they would have told unfavorable balance, I would have just started it with the same number in brackets as minus. How much is it? 1,05,980. Okay, this did not agree with the balance as per 1,05,980 is balance as per passbook. In the question, if they give us balance as per cash book, we'll always start with balance as per cash book. Here they haven't given balance as per cash book. That is the only reason why I'll start with balance as per passbook. What is our starting point in this? 1,05,980 passbook balance. Am I right? Okay, read the first one. Deposit of had not been credited by the bank till. So deposit is being made. When you make the deposit, cash book balance has increased. When you make the deposit, cash book balance has increased. It is not been credited by bank. So passbook balance has not increased. I'll repeat. Cash book balance has increased. Passbook balance has not increased. Where are we making changes? Passbook. What should I do? Add. How much do I add? 30,825. 30,800. Okay. Now let me show the answer to you. See, 30,825 is added. Starting is 1,05,980. Done. Come to next item. Read the next item. 48,400 not presented. When you issued the check, balance as per cash book has decreased. When will passbook decrease? When the check is cleared. Cash book has decreased, passbook has not. Where are we making changes? Passbook. What should I do? Minus 48,400. Observe. Less check issued but not presented. Minus 48,400. Done. After that, on 25th of September 2023, firm had entered into hire purchase. We have a similar one in ICS study material as well as in our material. Into hire purchase. Agreement to pay by bank order sum of rupees 25,000 on 10th of each month commencing from October till year end. Year ending is December. We're doing it is when? December 31st. So October, November, December, 3 months, 25,000 rupees in each month. We have paid by bank order. We gave instructions to bank. Banker has paid. How much? 25,000. Sorry, 25,000 for October, 25,000 for November, 25,000 for December. How much has banker paid? 25, 25, 25, 75. Banker has paid. When the banker has paid, passbook has decreased. For this transaction, there is no entry in cash book. Cash book entry is not written. Passbook balance has decreased. Cash book balance is not. Where are we making changes? What should I do? Add how much? 75. Observe. Add hire purchase installment 75. Clear? Some of us have this habit of writing all add items at one place, all less items at one place. There is no need. And you don't even have to draw two columns. Write everything in one column. One add item, two less items, one more add item, one more less item. In the order of adjustments given in the question, go on writing. Don't try to segregate. Time waster and space waster, and you will get irritated also slightly. Okay. Then add, and then you would have to do inner column and then total, inner column to outer column, then outer column total. Why? All the chaos. Then the next item. Third one over. Come to fourth one. A customer of the firm who received a cash discount of 4% on his account of 2 lakh. A customer has to pay us how much? 2 lakh. We gave him 4% discount. How much is 4% of 2 lakh? 8,000 we gave him discount. So how much should he give us? 2 lakh minus 4%. 1 lakh 92,000. How much should he pay us? 1 lakh 92. How much will he give us? 1 lakh 92. So when he gives us 1 lakh 92 instead of 2 lakh, we gave him discount of 8,000. In my cash book, I should write 8,000 in discount column, 1 lakh 92 in bank column. Am I right? Read. Paid the firm a check on 22nd December. the cashier erroneously entered the gross amount. So how much did he write in bank column? How much you should have written? 192. Because he wrote 2 lakh. Cash book went up by 2 lakh. And passbook went up by 1 lakh 92. Cash book went up by 2 lakh. Passbook went up by 1 lakh 92. How much is difference? 8,000. Cash book has increased. Passbook has not increased. Where are we making changes? What do I do? How much? 8,000. Shall I add 8,000? Observe here. 8,000 rupees checks received after discount. Wrongly entered at gross amount in cash book. Okay. After this, bank charges amounting to rupees 1,250 had not been entered in cash book. 1,250 rupees bank charges. Passbook balances decreased. This is not entered in cash book. 1,250 rupees entrance, bank charges when is entered in passbook balance has decreased, but cash book balance has not decreased. Where are we making changes? What do I do? How much do I add? 1,250. So I will write add bank charges not entered in cash book 1,250. Got it? Next, dividend of rupees 25,000 collected by bank was not recorded in cash book. So 25,000 is being collected by bank. Because the banker has collected this, bank balance as per passbook has increased. Because it is not entered in cash book has not increased. Where are we making changes? Passbook. What should I do? Minus. I will write here minus dividend received but not entered in cash book minus 25,000. This is how we arrive at balance as per cash book 147,655. Here this question you can't do amended cash book. To do amended cash book, starting point should be cash book. Understood? Then what do? We'll check timing difference, non-timing difference. All the timing differences are only 3. Check received but not cleared, checks issued but not cleared, errors in passbook. These 3 are timing, rest everything is non-timing. All the non-timing differences will come in amended cash book. If it is plus when you're starting with cash book, debit. If it is minus when you're starting with cash book, credit. When you close your amended cash book, whatever balance you get, should start with that balance and then do BRS after amended cash book. And that balance as per amended cash book is what will go to our balance sheet. And this is our discussion with regard to bank reconciliation statement. I hope everyone understood. And I hope there is no problem also with this. Very good. So far we have finished accounting process and bank reconciliation statement also. Okay. Shall we take a short break? Once we take a short break and come back, we'll do valuation of inventory and depreciation. Once we finish those two, we are done for the day. Okay. Short break. How much? About 10 minutes? 15 minutes break. 7:20, 7:30, 7:35. No, Sarila. Isilu Can we start? Close the door. Baglaki. Welcome back, people. Let's now start with chapter 4, valuation of inventories. To begin with, whenever you use the word valuation means representation in terms of money. We're trying to represent inventory in terms of money, because inventory is a very important aspect in determination of our profit as well as determination of financial position. If we don't write the correct value of inventory, our profit will be wrong. If we don't write the correct value of inventory, our balance sheet net worth will be wrong. So we need to figure out the right value of inventory. Inventory usually includes three variants: finished goods, work in progress, and raw material. For instance, if we are selling shirts, shirt is our finished goods, which is kept in the ordinary course for sale. This shirt is made out of cotton, which is raw material. But cotton to become shirt, first it should become thread. That thread, which is in the process of becoming the shirt, is work in progress. And in the raw form, when we bought it, it is cotton. That cotton is what we call as raw material. Did you get it? Say something. Very nice. So raw material is the material that will be consumed in manufacturing of finished goods. Work in progress is the item which is in the process of being produced as finished goods. Finished goods is the item which is held and used for the purpose of sale. Do you get it? Very good. So this inventory has to be valued correctly, because of this inventory will determine our profit and our financial position. Now, significance of inventory valuation. Like I told you, it will help us determine our income. If in case it is wrong, our profit will be incorrect. Just to make you understand, do you know this formula that gross profit is equal to sales minus cost of goods sold? I can reiterate this by identifying the value of cost of goods sold. Cost of goods sold is opening stock plus purchases plus direct expense minus closing stock. Opening stock plus purchases plus direct expense minus closing stock. Now, this closing stock, if it is wrong, cost of goods sold will be wrong. If cost of goods sold is wrong, then our gross profit will be wrong. Do you get it? Okay. Or if you see the trading account approach, we'll write opening stock, purchases, direct expense on the debit side, and then we'll write sales and closing stock on the credit side. If our closing stock, what we write on the credit side, is wrong, the total that we get will be wrong. If the total on the credit side is wrong, total on the debit side will be wrong, which if it is wrong, the gross profit resulting will also be incorrect. How will it impact? If in case I increase the value of my closing stock, what will be the impact on GP? Shall we see? Now this is the trial, this is the trading account. Do you see this trading account? Does it look fine? Does it look fine? Correct agidya? Absolutely correct. There is nothing wrong in this. Now let us say we'll increase the value of our closing stock. Instead of 25, assume that I made a mistake and then I wrote it at 30. What will happen to the total on the credit side now? Total will become 1,30,000 on the credit side. Debit side total also will become 1,30,000. Then how much will be our GP? 1,30,000 minus 55. 75,000 will become our GP. So GP was 70 when closing stock was 25. When I increase the closing stock from 25 to 30, my GP increased from 70 to 75. So can I conclude by saying, by increase in closing stock, GP will increase. By increase in closing stock, GP will, let us check other way around. Instead of making 25 as 30, let us say I took 25 as 20. When I take 20 in the place of 25, what will be total on the credit side? 1,20,000. Total on the debit side will become 1,20,000. How much will be GP in that case? 40 plus 10 plus 5, 55. 55 minus 1,20,000. So what happened? When the closing stock increased, GP increased. When the closing stock decreased, GP decreased. I'll repeat, when the closing stock increased, GP increased. When the closing stock decreased, GP decreased. When you guys come late, just sit where the place is available. You shouldn't make everyone change their places when you come to sit. Either come on time. If you come late, then don't make everyone stand. That's basic classroom decorum. And when you're already late and you're walking in, from there you cannot come with phone in your hand, earphones in your ear. Everyone has phone. Keep your earphones in your pocket, phones in your pocket, and then walk into class. And already late using the phone throughout when you come till here, then sit and then talk to your neighbor. Completely disrespectful and unaccepted behavior. I'm focusing on the subject. Let me please do that. You keep all of this outside the classroom. Don't do it for your good. I don't want to start with everything. Will you? Please remember, you are attending a class and it is not mandatory. You don't even have to come if you don't want to come. You should come only if you want to learn. If you want to be on your earphone or on the phone, or if you want to talk to your neighbor, you with your friend with your phone and earphones, you can get out. Please remember. Then the conclusion is, with increase in closing stock, profit will increase. With decrease in closing stock, profit will decrease. Let us see what will be the impact of opening stock. Opening stock will also be impactful because of an error in closing stock. You know why? This year's closing stock will become next year's opening stock. So this year if the closing stock is more, current year profit will be more. Next year opening stock will be more, because of which profit will become less. So ultimately the profit don't change for both the years together. When by increasing your closing stock, you are increasing current year profit and decreasing next year profit. So how does that work? Observe a very similar example. In this morning, if you are having Chitrana, it is because last day you have Tanglana. Previous year's closing stock will become current year's opening stock. And with this logic, let's see this. Let us take the same numbers what we had previously. Total on the credit side will become 1,25,000. Debit side if I write 1,25,000. 55 if I deduct, how much is GP? How much is GP? 70,000 is our GP. 55 minus buddy. 1,25,000 minus 70. Sorry, minus 55. Unlike my previous adjustment, I won't change my closing stock. Let me change my opening stock. Opening stock is 10. Let me make it 15. If I make my opening stock 15, debit side total, credit side total won't change. GP will change. Total is 1,25,000. 1,25,000 minus 45. Sorry, minus 15 minus 40 minus 5. GP will become 65. So with increase in opening stock by 5,000, GP decreased by 5,000. If it was increase in closing stock by 5,000, what would have added to GP? GP would have increased by 5,000. Am I right? Very good. Now, with decrease in opening stock, instead of making 10 as 15, let me make my 10 as 5. If I make my opening stock 5, total will be 1,25,000. Deduct 45,515. 70,000 if you deduct, we get 75,000 as our GP. So the conclusion is, opening stock if it increases, gross profit will decrease. Opening stock if it decreases, gross profit will increase. So the behavior is opposite. Do you get it? Closing stock increase, profit increase. Closing stock decrease, profit decrease. Opening stock increase, profit decrease. Opening stock decrease, profit increase. How do you remember this? Very simple. You know this movie Om Shanti Om? In this song, they keep on adding actors every 1 minute. Every 10 seconds, in fact. So when people go on adding, profit will decrease. They would have to give remuneration to all of them. Free, nobody does. So Om Shanti Om, profits will decrease. In Om Shanti Om movie, when they go on adding people, profits will decrease. So OSO, opening stock overvalued, profit will decrease. If I change it, OSU, opening stock undervalued, it will be ulta to that one. It will become profits will increase. If I call it closing stock overvalued, one item is changing no opening to closing. It will be reversal of the first one. Profit increase. What if it is CSU? Two things are ulta. It will become profits will decrease. So this is an easier logic to remember. Got it? Then after this, you would have to practice some questions on this. Then I'll teach you the ascertaining financial position. I told you inventory is very important. You need to value the inventory at its monetary value and then write in books of accounts. It will not just affect profit in P&L. Inventory will be written in balance sheet asset side also. If you write wrong value in the balance sheet asset side, capital and net worth calculation will also go incorrect. Got it? Then how do we value our inventory? It should be as per accounting standard 2. How should we value it? It should be valued as per accounting standard 2. As per para 5 of accounting standard 2, inventory should be valued at cost or NRV, whichever is less. How do we record it? Cost or NRV, whichever is less. And this entire process of valuation of inventory, remember it is accounting policy and it is not accounting estimate. Valuation of inventory is accounting policy. In chapter 1 when we discussed for accounting policies, I gave valuation of inventory as an example. Now, this cost or NRV, whichever is less, important point to remember, we should do item wise. Line to line, we should do cost or NRV, whichever is less. If they give 3-4 items of inventory, all the 4 items have cost, all the 4 items have NRV. Don't do total cost, total NRV, whichever is less. No, wrong. You should do each item of cost, each item of NRV, whichever is less. Each item of cost and NRV, whichever is less. Each item. You should do it for, we should not do it for total. Got it? Say something. Very good. After that, when we talk about the word cost, what all will cost include? Cost will include purchase price. Cost will include freight, cost of conversion, any other directly attributable expense. Any other directly attributable expense. Expense that you incurred to bring the goods to its present location and condition. Important thing to remember, if there is input tax credit, if there is tax paid, if there is input tax credit available, that will be adjusted against amount payable, so not to be included in cost. If input tax credit is not available, then we'll include it in our cost. Understood this? If there is any general administration expenses and all of that should not be considered. If there is discount available, deduct that discount and take the net of discount amount. And there is certain amount of details with regard to cost, what should be included, cost, what should not be included. I'll tell you what is included, what is not included. Administrative overhead will not be included. If you say something as administrative expense, it should not be included. What if you say some losses? We should check whether it is normal loss or abnormal loss. Normal loss value will be included in the value of goods. Normal loss will be deducted only in units column. Amount value will be same. Number of units would come down. Because of this, the per unit rate of each good unit will increase. Let's say we have 100 units at rupees 10, 1000 rupees. 10 or 5 units got lost normally. I'll deduct from 100 units. Number of units will become 95. Value will remain as 1000. So previously for 100 units value was 1000. Now for 95 units value is 1000. So rate per unit will increase because of normal loss. We won't write anything in amount column. If it is abnormal loss, we deduct the amount also, because of which value of the units will remain same. Per unit value will remain same. Remember, abnormal loss should be excluded. Normal loss will only increase the per unit cost. What will happen because of normal loss? It will increase our per unit cost. Did you understand? What about storage cost? It should be usually not included. It should be usually not included. However, if that storage is mandatory process of production, if you don't do storage, that product is not complete. Timber, rice, paddy, wine. So in that case, storage cost is included. Otherwise, it is not included. You learn this in detail in CA intermediate. Interest and borrowing costs are also usually not included. We'll discuss it in Inter. Accounting Standard 2, Accounting Standard 16. Right now, basics you understood? Say something. Very good. So what I wanted to know next is NRV. Whenever we say NRV, all the three you don't want. We'll only focus on finished goods NRV. When we talk about NRV, net realizable value, we should take selling price minus expenses to be incurred for selling those goods. We should take selling price minus expenses to be incurred to sell those goods. When you do selling price minus selling expenses, we get net realizable value. What do we get? Net realizable value. That is the value at which NRV will be considered. And we take cost or NRV, whichever is less, as the value of the assets. Understood this? Very good. Then the last part is about methods of determining the value of inventory. How do we find the value of inventory? We should check whether the inventory is ordinarily interchangeable or not ordinarily interchangeable. Ordinarily interchangeable means what? One unit can be replaced with another unit without any difficulty. There is no separate identity for each product. In that case, what do we do? Considering historical cost. Considering historical cost. We have FIFO, LIFO, SAM and VAM. Without considering historical cost, we have adjusted selling price method. However, if each unit is unique, each unit is customized, one cannot be replaced with another, then we follow something called as SIM, specific identification method. The value of each unit of inventory has to be separately identified. Example, jewelry shop or designer wear. Each unit is different. No two chains value will be same. No two sarees price will be same. There, each item's value you identified separately. If it is normal men's shirts and all, any shirt in the track will be same price. So find the value of one shirt multiplied with number of shirts. That's where we do what to say FIFO, LIFO, SAM, VAM and ASP. FIFO is units that is received first is issued first. So closing stock will be from the most recent purchase. Last in first out is what is purchased most recently. Lastly bandidu will go out first. So closing stock will be opening stock on very first purchases. Simple average method, we take entire inventory together. We'll take first rate plus second rate divided by 2. But this doesn't give any importance to units that we carry. If I purchase 100 units at rupees 10 and I purchase only 1 unit at rupees 12, rate for 101 units is 10 plus 12 divided by 2. I purchased how many units at rupees 10? 100. I purchased only 1 unit at rupees 12. Let's say I have all 101 units in my closing stock. You know what is the value? 101 units multiplied by, what is the rate? 10 plus 12 divided by 2. How much is 10 plus 12 divided by 2? 11. 11 rupees per unit for 101 units. How much is the value? 101 into 11 is how much? $1,000. Why are you guys getting different answer? 101 units into 11. 1,000. 1,111. 101 units into 11. But actually, how much did you pay? For 100 units, you paid 10 rupees. That is how much? 1,000. For 1 unit, you paid 12. What is the value? 1,012. You should get 1,012 as value. You're getting 1,111. How did 1,111 become 1,012? Sorry, how did 1,012 become 1,111? Because we took average. So simple average is bakwas. It is incorrect. It doesn't give any significance to weight. Doesn't give any significance to. It is like me telling class has 100 students. 99 students scored 80 marks. Only one student scored 1 mark. Or only one student, let's say, scored 10 marks. How many students are there in the class? 100. How many students scored 90 marks? 99 students scored 90 marks. Okay, only one student scored 10 mark. Average I am doing 90 plus 10 divided by 2, 50% is the average score of the class. Is that right? No. I should do X and F, summation Fx divided by capital N. I cannot do only total of F and then divide by number of items. Incorrect, alva. You get it? That's what we're doing in simple average. So we should go for weighted average. Weighted average is like summation Fx divided by N. We'll take weight into rate to arrive at the total amount. Are you getting it? Total amount divided by total units is done to find out the weights. So that is more appropriate. You always do this FIFO, LIFO, SAM and WAM from the perspective of inventory. See that like statistics. That will start making so much more sense. See that like identifying mean. It will make so much more sense. Are you getting it? Very good. Then after this, we need to know the inventory record systems. There are two inventory record systems. One is periodic, other one is perpetual. Periodic means we use the COGS formula to apply the valuation of inventory. This is incorrect, unscientific. Perpetual is detailed and scientific. We maintain records for every unit coming in, every unit going out. If you ask me what was the inventory on 15th of May, I will tell. If you ask me what is the inventory on 23rd of May, I will be able to tell. Under which method? Perpetual. Under periodic, I can't tell like that. The day you tell me how much inventory, I'll physically count the inventory, I'll apply the formula and tell. If the date has passed, then I can't tell the value. If there is some loss that has happened, we cannot identify how much have we lost because there is no control. However, if we do perpetual, as per books we'll arrive at some inventory, as per physically there is some inventory, we can compare them and tell if there is anything wrong. Understood this? Then we'll quickly see the stock reconciliation. This is your favorite questions from the topic. Am I right? So there are two kinds of stock reconciliations. One is forward, other one is backward. And there is one special one involving physical inventory. What do you mean by stock reconciliation? That stock adjustment problems? Very simple. In order to write the inventory in balance sheet, we cannot look at any ledger and write. Purchase total you can get from purchase account. Sales total you will get from sales account. But inventory, there is no ledger account. Do you prepare anything called inventory account or stock account? So inventory value has to be computed by physically counting the inventory. Physically look at the inventory and then count it. But to count the inventory, you might not be able to do it on 31st of March sometimes. 31st of March you are busy or the client is not letting you count the inventory or some other problem. Because of this, what's happening? You counted the inventory on 5th of April or you counted the inventory on 25th of March. Now using the inventory that you counted on 25th of March, you want to find the inventory on 31st March. Or using the inventory that you counted on 5th of April, you want to count the inventory on 31st of March. This is what we mean by reconciliation. You are not doing the inventory count on the day you want the inventory. You are doing it on a date ahead or you are doing it on a date before. Using that, you are arriving it on 31st of March inventory. Let's say I counted the inventory on 25th of March. I know what is the inventory on 25th of March. Keeping 25th March inventory as base, can I find the inventory on 31st March? Yes. How? 25th March inventory plus purchases minus sales or plus inflows minus outflows between 25th and 31st. If we do that, I'll get 31st March. Am I right? I will go count the inventory on 25th March, come back with one number. That number is there in my mind. I will ask my client or the department or the company, give me details of purchase, sales and all the stock movement from 25th March to 31st March. They'll give documents, only those documents I'll check, add purchase, deduct sales, add sales return minus purchase return, over, I'll get 31st of March inventory. Got it? From 25th March, if you're going to 31st March, it is called forward problem. What is it called? You add inflow, you minus outflow. You add inflow, you minus outflow. Then we have something called as backward problem. What is it? You counted the inventory on 5th April. From 5th April, you are coming back to 25th of March. Sorry, 31st of March. You are coming back, no? You are doing backward, ulta. So sales is usually minus, purchase is usually add. Now we should do ulta. Sales will be added, purchase will be deducted. That is backward problem. Only thing that you should remember is when you are adjusting sales, you should adjust it at cost price. At what price should you adjust? See, after the year end, if the physical count is done after the year end, that is on 5th of April in our example, we are coming back to 31st March. What problem is it called? Backward stock reconciliation problem. What do you mean by before year end? From 25th March, you are going till 31st March. What problem is it called? Forward stock reconciliation problem. What is it called? Forward stock reconciliation. Very good. So if it is forward stock reconciliation problem, sorry, if it is backward, we are going from 5th April to 31st March. So usually forward, what do? I add purchase, deduct sales. But this is backward. What is this? I will add back sales and deduct purchases. Meaning I will add back, outflow, deduct inflow. Inflow should be added, outflow should be deducted. Am I right? We are doing backward. So what do? I will deduct inflow, I will add outflow. Understood? But sales should be written at cost. Sales should be written at cost. Remember to adjust sales with sales return, purchases with purchase return, and then write it. Sales will be at selling price, eliminate the profit portion and then write it at cost. Clear? Then after this, before year end, if you do it before year end, then what's happening? We're doing it on 25th of March, but we should find the inventory on 31st of March. How do we go from 25th March to 31st March? We're going forward. Inflow will be added, outflow will be deducted. Inflow will be added, outflow will be deducted. Did you all get this? If in case they give physical inventory, remember to adjust only if the physical inventory changes. Let's say they've given physical inventory on 28th of March. They want you to find physical inventory on 31st of March. Remember to add only if the physically goods are moving. Remember to deduct only if the physically goods are going out. Are you getting it? I'll repeat. If they give book inventory is all of this. One kind of question what people find difficult is stock movement, which is physical. They'll tell inventory, physical inventory in the go down as on 28th of March, so and so. Find the physical inventory on 31st of March. How do you find? If the goods are sold, we won't do minus. If the goods are sent, we do minus. Goods are not sold but sent, still we will deduct. Goods are received, we will add. Goods are purchased but not received, we will not add. Goods are purchased but we have not yet received it, will you add? Goods are received but actually not purchased, we'll add. So basically we'll take care of what? Physical movement of goods only, not bookish movement of goods. Are you getting it? You should remember consignment and goods sent on return or approval also carefully here. With regard to goods sent on return or approval, remember that goods will be only sent, not sold. Goods will be only sent, not sold. If I've sent goods on return or approval, it is not sale. It is not sale. The inventory is with the customer, but it belongs to me. That entire inventory, what I've sent on return or approval, it is not sale. It is my inventory. I should include it in my stock. I should add it back. If you take physical inventory on 31st of March or 5th of April, that in my go down when I count the inventory, is that stock counted? Why? That stock is with customer. Does that belong to him? It belongs to me. So I should add it. I should add it. What if he has returned it to me? If he has returned it, it's already there in my go down. When I count it, it will be already counted. So I don't have to add again. Let us say I have sent goods on return or approval basis 10,000. He has returned 40% of the goods before the counting. So 40% is in my go down. I've already counted it. I don't have to add 40%. How much do I have to add now? 60%. What if that 60% is accepted? Then I don't have to add. Why? It is sales. Do you agree with me? Yes or no? That 60% is not accepted. Then I would have to add back. I should add back at cost price. Should add back at? Everyone understood this? This is one goods sent on return or approval adjustment. Next, consignment adjustment. What will be with regard to consignment? Let's say I am consigner and I have someone called as consignee. I have sent goods to my consignee. Have I sold it? I have only sent goods on consignment. When I send goods on consignment, the inventory will not be in my godown. It will be with my consignee, but I have the ownership. That inventory will belong to me. I have the ownership and that inventory will belong to me. Let us say 10,000 worth of goods are sent on consignment. 10,000 worth of goods are sent on consignment. I don't have that inventory with me. Do I have it with me? I don't have it with me. But is it mine? Yes. When I physically count the inventory, would I have counted it? Why? I counted only inventory in my godown. Though that inventory is not in my godown, though it is with consignee, it belongs to me. So I would have to add it. One question in your material, it has ulta adjustment. You have received the goods on consignment. So you are the consignee. If you have received the goods on consignment, are you the owner? You are only keeping possession of the goods. It is there in your godown. When you count the inventory, that is also counted. But does that belong to you? No. What should you do? Deduct. What should we do? Deduct. This is the adjustment with regard to goods sent on return or approval and consignment. With this understanding, if you go back and then solve those problems, you will be surely able to solve that problem without any difficulty. Can we go ahead now? We are done with inventory actually, but we'll see that RTP question on inventory. RTP lane question is there. There is a trader who has purchased goods. Okay. A trader has prepared his accounts on 31st of March every year. Due to some unavoidable reasons, no stock taking could be possible till 15th April. So where have they taken stock taking? 15th April. When are we trying to find the value of inventory? 31st March. Are we going forward or are we coming back? We're coming back. So remember, we're doing backward. Inflow will be deducted. Outflow will be added. Total cost of goods in the godown came to how much? 50,000. On what date? 15th of April it is 50,000. 15th of April it is 50,000. This is question number 6. Let me make some small notes here, not in detail. Yeah, observe. Physical inventory as on 15th of April, 50,000. Everyone understood this? Say something. Okay, very good. What is happening after this? Sales is 41,000, including cash sales 10,000. We don't care whether it is cash sales or credit sales. We don't care whether it is cash sales or credit sales. Sales is outflow. Sales is, but we are doing backward. So I will add. Did you understand why am I adding sales? Nobody has doubt with this. So I will add back sales. I'll mark whatever I picked into green color. Is that fine? So I will add sales. How much is that sales? 41,000. I'm writing it add, but I am not actually adding it. Why am I actually not adding it? We should do it at cost price. We should do it at what price? 41,000 is selling price. 41,000 is. So I'll adjust sales return, then I'll eliminate profit and then I'll add. What is the next adjustment? Purchases 5,034. Doesn't matter cash or credit. Purchase is how much? 5,034. Purchase is usually added. But because it is backward, what do? Deduct it. I'll write minus purchases. How much? 5,034. There is no adjustment of selling price, profit and all in purchases. Purchases is always at cost. Am I right? Third adjustment. Sales return 1,000. Sales return 1,000. I can treat it like purchase or adjust it from sales. It will become easy. It will become easy if I adjust it with sales. How much is sales? 41. In that return is 1,000. Net sales will become 40. So from sales I'll eliminate 1,000. Please don't try to add sales return here separately. Why? This 1,000 is at selling price. We should eliminate profit from that 1,000. There is a very high likely possibility that you will forget profit margin if you treat it separately. So always remember sales return deduct from sales. Purchase return deduct from purchase and then take the net purchase or net sales after profit adjustment to outer column. So from 41,000 sales, I'll eliminate sales return 1,000, making it 40. Okay. Then what do we have? On 15th of March, goods of sale value 10,000 were sent on sale or return basis to a customer. Now I have sent these goods. Have I sold or have I sent? Does those goods belong to me or to my customer? Belong to me. When will it belong to my customer? When he accepts the goods by saying yes, or time to return the goods lapses. Unless until they mention the time has lapsed, or he has told yes, it is not sales, it completely belongs to me. Am I right? Continue. The period of approval is 4 weeks. That is, time is there till 15th of April or sometime. He returned 40% of the goods by 10th April. He returned it by 10th April, how much? 40%. So out of 10,000, 40% has come back to me. When did it come? When did I count the inventory in my godown? When did I count? 15th April. When did I count? 15th April, when I counted the stock in my inventory. Have I counted that 40%? Yes. Why? It came on 10th. I counted on 15th. So 40% is already included. Before I add 40%, how much of that 10,000 belongs to me? Entire 10,000. How much is my inventory? Entire 10,000. Does 10,000 belong to me? Why are you saying no? 10,000 belongs to me. Have I sold it? I've only sent it. Only possession has been transferred. Ownership is still with me. Entire 10,000 belongs to me. By 10th April, he returned 40%. 40% when I counted on 15th of April, it's already there. How much should I additionally include now? Very good. How much should I additionally include? Did you understand? Now continue reading. Approving the rest. The customer was billed on 16th April. Doesn't matter. Why? We're finding the inventory as on 31st of March. As on 31st of March, has he accepted it? No. 31st of March, entire goods will belong to me. So, entire 10,000 should be taken in my inventory. When I counted on 15th April, 40% is already counted. 60% is not counted because it is there with customer. I should add that 60%. How much is 60% of 10,000? But that 6,000 is at selling price. I should eliminate it, profit margin and then take. So I'll add 6,000 by writing it here. Did you understand this? Goods sent on return or approval basis, selling price 60% should be included. Then trader also received goods costing 8,000 in March for sale on consignment basis. So we are consignee. Who are we? We have received goods worth 8,000. Are we the owner? We are not the owner. What do we have? Only possession. What do we have? Is it my inventory? No. When I count the inventory on 31st of March or 15th of April, will that be there in my godown? Yes. Would I have counted that? Yes. But is it mine? No. What should I do? Minus. Correct? Huh? But read further. 20% of the goods have been sold by 31st March. So 20% goods have gone out of the factory, out of the godown. How much is there in the godown? Only 80%. So in the closing stock, how much will be there? 80. How much should I eliminate? 80%. 80%. 20% is gone. 80% is there in the factory. When I count, how much would I counted? 80. So how much should I eliminate? Understood? That is not over. Further they're telling another 50% is sold by 15th April. When am I counting the inventory? By 15th of April, 20 and 50, 70 is gone out. How much is there on 15th of April in the godown? On 15th of April, when I'm counting, how much is left out? Does that 30,000 belong to me? Whom does it belong to? Consigner. Who am I? Consignee. When I took that opening balance, whatever we counted here, that 50,000, that includes this 30%, which will eliminate now. 30% of 8,000 is how much? 2,400. 8,000 into 30% is not 24,000. How much is it? 2,000? 2,400. Let us deduct. Shall we deduct 2,400 here? That's it. Minus. And finally, they have given profit is 20% on sales. Here we have sales, no, 40. Profit of 20% you deduct. 8,000 damar. 40 minus 8, 32. Here we have sale price of 6,000. Eliminate profit of 20%. 1,200 if I eliminate, what will I get? 4,800. That's it. Everything is done. 50 plus 32 minus 5,034 plus 4,800 minus 2,400 will give us 79,366. Did everyone understand? Pakka? Very good. That's how we find the value of inventory. I have given a small note to understand the concept of goods sent on return or approval basis also. In case you read this, you will understand. I'll share this complete solution for this particular question to you people later. Yes, sir. Same question is there with different numbers or same numbers? Same numbers. Whatever. Even if it comes in the exam, just don't tell same numbers. I won't solve. Same question is there. ICS study material. Don't write like that. Please write. No. ನೀನ್ ಮಾಡ್ದೆ ಅಂತ ಹೇಳ್ತಿಲ್ಲಪ್ಪ. ನಾನು ಜನರಲ್ ಆಗಿ ಹೇಳ್ತಾ ಇದ್ದೀನಿ. If you would have done the same question, let's say RTP question, something comes for the exam. Don't tell. Same question is there in RTP. Refer question number 6. Don't write like that. Write your answer. It is okay. Then they will say same result like what happened last time. Check your last time result. Don't play games with ICI. Okay. Then by this we are done with our valuation of inventory also. So next in we would have to do depreciation. Tomorrow na. ಜಾಸ್ತಿ ಆಯ್ತಾ ಇವತ್ತಿಗೆ? But are you happy with what we did? Does this give you a sense of satisfaction that yes, we have done something in class today? Very good. So let us start with depreciation and amortization in tomorrow's class. I'll quickly run you through methods of depreciation and how depreciation is computed. We'll do an RTP question. Amortization is something new. There we'll spend little time on amortization. I'll tell you how is amortization different from depreciation, and that one new problem what is in the material, we'll just glance it through because it is newly added. Then we'll do bills of exchange, final accounts, NPO and incomplete records. Is that all fine with you all? So we plan to do 1, 2, 3, 4, 5. We have done only 1, 2, 3, 4. I hope that doesn't leave you unhappy at the end of the day. Good enough? Did it help you the last few hours of discussion on 1, 2, 3, 4? Please go home and then solve questions on 1, 2, 3, 4 and then ensure that you practice it today only. Then hoping you all to get a good night's sleep and hoping to see you all tomorrow in the class on time. So did you guys learn something new today? Did you guys have little fun today? Remember, life is not a battle to be struggling, it's a game to be enjoyed. Till the time you're learning something, you're having fun. It's all good. The day you guys stop learning something new or you stop having fun, trust me, you might start struggling because you might be in a battle. So thumb rule to stay happy is pretty simple. It is to stay in the game. So for one last time on this day, I have just one simple question for all of you. Are we in the game? Are we in the game? Come on to the top of your voice. Are we in the game? That's it, guys. Tada, bye-bye. Take care. See you all tomorrow in the afternoon at 3 p.m. Till then, have a great time. Get lost. Bye. For people watching it on YouTube, I hope it was helpful to you people too. See you all tomorrow at 3 p.m. on the same YouTube channel. Till then, take care. Bye-bye.